was something that they were interested in, and we've been working with them extensively. We're trying to get them to rate a bond with Bitcoin as backing. I think for them the liquidity is amazing. Bitcoin liquidity is much higher than anything they typically look at. We were talking about a potential liquidation scenario of $100 million worth of Bitcoin, and they're thinking in months and weeks, and we were talking about hours, and it was something that was hard for them to wrap their head around. I mean, one comment was, "Oh, so it's as liquid as IBM." And I'm scratching my head. I'm like, no, it's a lot more liquid than IBM is. And so I think from that perspective, traditional finance, a lot of the existing infrastructure, a lot of the people looking at crypto as collateral, crypto as an asset, they're still catching up in the way of thinking and developing that understanding of the asset.
So how does collateralization and yield change the game for things like ETFs, DATs, bond instruments? What happens when suddenly there's a predictable source of yield in these instruments?
Yeah, so I'll jump in there. I think I have been spending quite a bit of time running around different industries, including Japan and the current counterparties in the US to try to source liquidity for Bitcoin backing and so forth as part of the DAT work and also as part of Wave. And I think that that's a very interesting discussion. I think the current result is that the Japanese industry isn't quite ready to take Bitcoin on as collateral. There's one small player that is providing some loans at very small amounts. I think they cap at about $3 million. And a lot of the large players are interested. I think there's a general impression that they'll be able to do this at the end of this year, early next year. In Japan, also, the laws are changing. They're moving crypto from the payment systems like mileage and points and crypto, and they're moving that into financial instruments. And once that gets done, I think it'll be a lot easier for them to accept as collateral. In the US, I think most of the counterparties we work with, it does lend versus Bitcoin. So it is much easier overseas. But in Japan specifically, I think I was hoping to take advantage of the lower interest rate to be able to borrow cheap capital.
I mean, we have the right answer here. We know what the answer is, and we just need to be able to do it better than what exists today in capital markets. And the collateral use case is likely the best use case that has come out of the crypto and blockchain as an industry. And I mention that because if you look at any if you look at any capital market, but definitely here in the US, and you were to say, well, how should this thing work? It is filled with what we call legacy systems. Like it doesn't make sense the way it's built, but it exists the way it is because the rules that were set, the technology that existed at the time, and access to be able to participate in these markets. With Bitcoin, and in particular, Bitcoin being used as collateral, we now have an ability to really reimagine how these things should work the right way, not the inefficient way, not the legacy system way, but how can we rebuild markets so that the use Bitcoin and its use as collateral can be done the way in a common sense form instead of putting it into a broken and legacy system. And so we're kind of dealing with the merge and the integration of the two as we think about the future of capital markets. You had mentioned DATs. Okay, well, DATs are publicly traded companies that have Bitcoin on their balance sheet or other digital assets. They are innovating in the legacy capital market way, right? But they have to do that in order to access the existing distribution that the traditional capital markets offers. And so we're at this moment where, okay, creating a publicly traded company that puts Bitcoin on their balance sheet, that may not be the way that we would sit here and imagine would be the right way to build it or the most efficient way, but we have to do it in the legacy system. And so we're doing this for 10 years. Ben's been doing it for 10 years. It's been tough to battle through it, but we're starting to get there, and we're starting to reimagine these new systems. And obviously, Sui is at the forefront of that.
So let's talk about what's happening in this moment in technology. So obviously, crypto is reaching an apex in terms of its penetration into the markets, into instruments like mechanisms like Hashi that allow for the collateralization of Bitcoin for dollar lending. What's going on with AI? How does AI enter this picture as these capital markets evolve?
I mean, it's the ironic thing is our industry, blockchain and crypto and digital asset, might have been built for the machines, right? We didn't really know it, but it may have been built for the machines. What does that mean? If we are in a world where we have AI agents doing various things and they are moving stores of value or medium of exchange digitally, what are they going to use? They're definitely not using physical dollar bills. Are they going to be using digital versions of fiat-based currencies, or are they going to use digitally native assets, stores of values, medium of exchange, as they move value across, the internet or across the Ethereum space, right? And this is where the most exciting thing is, because we call it the velocity of innovation is happening so fast. Like smartphones weren't here, we're not even 20 years in smartphones, right? And we're already talking about, agentic AI taking over our personal payments. And so what is going to be that asset that moves value? It's going to be a digitally native asset, and those only exist from the things that we've created in our industry. So that's the most exciting part. That's like the top down. There's a lot of nuanced detail that we have to get right in order to allow for trusted movements of these assets. And that is a big ask. Like we do have to get it right, or else we're going to have more AI agent, U.S. Marshal, sons moving assets where they shouldn't be in the same parts equivalent of the AI world.
Yeah, just I'll add to that comment. I think crypto fundamentally is different from other assets in certain ways. I think one of the things I talk about in my class is that, looking at store of value, Bitcoin is a much superior instrument as store of value compared to the likes of gold and other instruments. It's easier to store, it's easier to transport, it's easier to do settlements across long distances, and so forth. And one of the biggest advantages is that it is an easy to use bearer instrument. We couldn't imagine having AI move gold around. We couldn't imagine having AI move other instruments around as real bearer instruments. And the idea of bearer instruments is actually very important, because if you think about it, you have people investing and buying in equities. For example, I buy Apple shares on my Interactive Broker account or people's Robinhood account. You don't actually own those shares. They're recorded at DTCC. Officially, DTCC is holding those shares. It's just a record of who owns what. Robinhood or Interactive Broker, any of the other brokerages are making a record of, oh, you bought this, you sold that. And the control is really centralized, is really there. Whereas when you have bearer instruments, when you're transferring something, someone sends somebody else a Bitcoin, that Bitcoin actually exists across the board. You hold the keys, you hold the Bitcoin. It is a true bearer instrument. And I think it's probably required that AI have bearer instruments to be able to transfer from one AI agent to another, as opposed to a ledger or recording process in the current traditional financial way.
Elliot, let's talk a little bit about yield sources. So you've been in this business again for a decade or more. How does the Bitcoin yield, how should we be thinking about the Bitcoin yield and its sources and its viability long term?
Well, one, Bitcoin is, in my view, the most transformative asset in my lifetime. Two, the collateral use case is the best use case that has been uncovered from our industry. And then third is, so what? We need to make these assets productive. And that is where the yield generation comment comes from. And our industry does a not so good job of using terms incorrectly, and yield is one of them that we can do a much better job of defining. It's vital these days to understand what is happening in order to generate that yield. There's only 4 ways to do it. Like, one is you stake the asset. The second is you lend the asset and you receive a return for that. The third is you sell volatility, i.e. sell covered calls. And the fourth is basis trading. And there's perps basis, and then there's calendar basis. You have to be able to, if you want to generate yield And it's your responsibility. It's the responsibility of the holder to know this, to do the research and do it. We say do your own research. Do your own research. But more importantly, in the Bitcoin world, you have to understand how that yield is generated. And when organizations that say they do things can't clearly explain what they're doing, you should get the red flag and say, hold on a second, like that just doesn't sound right. And so with the technologies nowadays, we have the tools to be able to understand how things are, how yield is generated, how these assets are productive. But the responsibility lies with the asset owner, right? And we have to do a much better job of educating. We have to do a much better job of giving the tools. And I think we're at the cusp of being able to provide those for the asset owners.
Yeah, I think Elliot's points are very direct, and I think those are all correct. At Wave, we've been looking at these asset classes. We were just talking about this. Wave launched the first cover call Bitcoin strategy 6 years ago. So we've been running that strategy for quite a while. More recently, I think there's announcements from BlackRock and others that are starting to do something like that. And I think that's a very important aspect. Unfortunately, Bitcoin doesn't really have a staking yield. So we're looking at lending, we're looking at borrowing, we're looking at other ways of generating a return on that. But it's certainly a very interesting space to look at. There's a lot of attention to it. There's a lot of people with a lot of assets on it. I go and I see advertisement about people using Bitcoin to try to borrow money for real estate and so forth. So people are starting to head in that general direction from a asset perspective.
Well, thank you both for joining us for this conversation. One last question here before we wrap up. What are the odds that Clarity passes this year?
I don't know. I would love for it to pass. I think I'm very supportive of it overall. I think most of the contentions points have been cleared up, but I think the political process is always very complicated. So I think it's being held up. And I'm actually not sure. I would say maybe 50-50 at this point.
I'm saying 100%. Something is going to pass this year. The what of the details is the question. And we all have to hope that it's in our favor and not in the favor of traditional legacy systems, because they're gone in the future. We all know what it is, and let's get that regulations. It is important, but it's 100%. It's going to pass.
Thank you both.
Thank you.
Thank you, Ryan, Ben, and Elliot. For those of us in the studio, before we bring our next speaker on, let's do a quick exercise. Let's see who's a real Sui OG. So help me out, folks. Everyone just put your arm up. Put your arm up, everyone. Yeah, just one arm. If you're here today, then that means you've been to at least one Sui event. That's why we have our arm up. If you've been to at least 2 Sui events, keep your hand up. If you've been to at least 3, keep your hand up. If you've been to at least 4, 5, 6. All right, we got these 2 gentlemen. They work for Sui, so that's not really fair. But we got this lady holding up a quiet please sign, so that doesn't count. And then this gentleman over here. Okay, you've been to 6 events? Okay, just to show that you're telling the truth, which one's your favorite? Abu Dhabi. Have we been to Abu Dhabi? I don't know. Okay, well, here's a prize for you, sir. Thank you for being a Sui OG. I have here a real limited edition Sui gold-plated necklace. So it is worth something, but it's not worth everything. So ladies and gentlemen, please welcome this gentleman. Here you go. Thanks for being a supporter of Sui. All right, moving right along. Let's welcome our next keynote presenter to the stage. His name is Arpan from Beep, and he's going to be talking about agentic finance and how it powers the machine GDP. Ladies and gentlemen, please put your hands together.
Hey everyone, good morning, good evening. Hello to everyone that's streaming in live. My name is Arpan. I'm the founder of Beep. We're an agentic finance protocol. In the next 15 minutes, we're going to cover a new species of economic actors called as AI agents, how they're locked out of the system, and how Sui unlocks that ecosystem, which unlocks a trillion-dollar machine economy. And then at the very end, I'm going to leave with a very sweet product demo, first of its kind that we're launching on Sui, and probably first of its kind within the entire crypto ecosystem. So let's go. In 2011, Mark Andreessen, founder of Netscape and founder of A16Z, wrote Software Eats the World. What followed over the next decade was software ate transportation, software ate finance, software ate retail, software ate media. But something has happened and is happening in the last 18 months till date, is AI has started to eat software. What this means is look around us. We use Claude or ChatGPT for all research tasks. We use Devin to ship code. A bunch of other activities that are replaced by AI and AI agents that are replacing human jobs. It's not as alarming. It's actually enhancing activity. But what this means is each of these transactions that are done by agents that are replacing this human job is not one-to-one. An agent can do 1,000 times more than what a human would do in that particular job. This leads to, let's take an example of agent shipping code. Because of that, now it can invoice, it can bill, it can collect payments, and auto yield that revenue on the payment. What this means is every single transaction in this agentic world is a financial economic transaction, and it's a big exhaust of transactions. The system that can process this exhaust doesn't really exist. Why does it not exist is a very critical question. So today, all economic activity is centered around humans, human identity, human speed, human KYC, human passports, human social security numbers, et cetera, type of stuff. Well, guess what? Agents don't have any of those. Agents can't just walk into Bank of America or Chase and say, open a checking account or an investment account for us. Which means there's tons and tons of economic actors and AI agents coming on chain, but they're completely locked out of the system. So for this new species, it's not a bug. It's essentially a locking out of the financial system. And highly unlikely the regulators are going to pass some law that allows a Python script to conduct economic activities, which makes agentic economy more native to on-chain economy, and it's permissionless. Now, if we assume that there's tons of economic activity happening through economic actors, how do we measure it, right? How do we measure success? And this is where we're calling something as machine GDP. Today, human GDP is about $100 trillion. It's measured on a quarterly basis. Analysts debate over it for the next 2 months, et cetera, type of stuff. So it's a rear view metric. With machine economy, what we get for everyone here is a live dashboard of all the economic activity that is conducted by agents. And we're calling it as MGDP. So essentially what this means is MGDP becomes a live dashboard of metrics and economic activity versus a human GDP, which is a rear view mirror. Another important question that comes up is why now? Why not? I keep getting asked this question, why didn't this happen 5 years ago? We had bots 5 years ago. We had Python 5 years ago. Why can't it happen 5 years from now? There's 3 key trends that are converging and compounding for the very first time, and it's happening in 2026. The very first trend is tokenized everything. All you guys are seeing it, where assets, Wall Street assets, real estate, any of these traditional assets are coming on chain, which means there's a very large investable tradable asset class now that is available for agents, which is the new species. Number 2 is permissionless fast blockchains. 3 years ago, chains were built for human activity, maybe 2 trades a day, maybe 10 trades a day if you were degens. But agents do thousands of transactions on a second-by-second basis. So those permissionless rails with Sui are now available for agents to execute really fast transactions and conduct economic activity. And then the third is the cost of intelligence has dropped significantly. Over the last 3 years, the cost has dropped 1,000x, which means the number of agents that has gone up within the network is another 1,000x. And guess what? every time the cost $1 of inference drops, there's 100 times more agents that come online, which are locked out of the financial system. So these three trends, converging and compounding, are resulting for a perfect time where you have cheap agents that are economically viable. You have a very large tradable economic asset class via tokenized everything and permissionless, very fast rails through Sui, leading to a first point in time where agentic finance becomes as a possible category. So the next question becomes, how does this all work together? And like, why Sui? I think the key question here is, or the key point here is, the L1s that have been built so far are built around human activity, human wallet transactions, maybe 2 to 3 transactions, maybe 10 transactions a day. But agents live in a different world. Agents don't operate in that manner. Agents do about 1,000 to 2,000 economic transactions per second. And in that world, you need a chain that's not just fast, like it doesn't do batching, any of that stuff doesn't work as you would do in an L2, but you need a chain that settles immediately. And Sui, having the object model with parallel execution of that object model, makes it a perfect fit for agents to wrap an object in an asset class, program it, operate it, transact it, and execute it. So the Sui architecture is super elegant, and it's like perfectly fit for any agent to conduct thousands, if not hundreds of thousands of economic activity on chain. So Sui, in my opinion, becomes the default agentic native stack in this machine economic world. For all the engineers in the room, as well as dialing in live, how does this all come together? At the very base layer, you have the L1 of Sui chain, which does the execution, record management, and the ledgering. Right above that, and this is the most critical piece, in my opinion, when it comes to agentic architectures, agents need memory. It's not just brain and intelligence. The intelligence comes from the LLM, but for intelligence to be intelligent, you need context, and you need state, and you need history. So the storage for which we use Walrus, which is a perfect fit, it's a decentralized context storage used by agents to both write and read in a permissionless, decentralized, highly secure manner. So this is not sitting in some database, but it's sitting in wall chain. And the beauty of this is this all comes packaged with Sui. So it's like a perfect fit for any developer building any agentic apps. On top of that, you have the security layer, like all of these trading strategies, context, all of that. You want to wrap it in an encryption layer, not, again, in a decentralized on-chain world. And that's where Seal comes in. Again, my key point is agents don't have KYC. So it's not like agents can provision an AWS instance or a Google Cloud instance to be able to do all these things. So Sui stack becomes the default stack to enable intelligence, execution, ledgering, memory context layer. And then on top of that, we have the exchange layer, which is powered by Beep, to provision an agent under a minute or 3 minutes to be able to conduct activities all across the board. So very cool. It's like a single line drop-in SDK, and within 10 minutes, an agent is up and running. You have an economic agent that is up and running on Sui. What we have live today is a complete system of 3 financial activities. Payments as one. We have a forwarding protocol that allows agents on Sui chain to transact with other protocols, and it's cross-venue, cross-execution chain. We have agentic yield. One of the biggest pet peeves for me is if there's idle capital, it should be yielding at all times. And agents come in, agents execute that. So, and then the third one is markets, prediction markets, and trading markets. We have about 1,900 plus asset classes that agents can trade against all 3 of these models. Now, a very exciting moment, and as you can see in the image, it's from the Apollo landing scene, is for the very first time, we're launching a new vertical of a product, which is called as Agentic Capital Markets. What we're going to demo, or what you're going to see as a demo on the next screen, is any user can provision a yield strategy, be it an institution, be it retail, fully democratized. They can create a yield strategy, tokenize it, collect capital against it, take rev share, and allow multiple participants within the network of agents to participate in this tokenized world. So we're very excited about this. I think if not first in Sui, this is definitely first in all of crypto, where even capital market functions are moving agentic and they're moving in crypto. So it's a big moment for all of us here at Sui, within the Sui community, Sui developers, and just in crypto in general. So let's watch the demo real quick. And we've taken some pun names on your traditional Wall Street names. So see if you can find those. Awesome. All right. Hopefully that was very exciting. We believe in the next 5 years, MGDP, short form for machine GDP, is going to be $1 trillion plus asset class. And Sui is going to be the chain that's going to be running this economic layer for new species. So it's an exciting time. I want to leave you with something. Scan the QR code. The first 50 folks will get access to the Agentic capital markets product. So go crazy, build your trading strategies, launch them on chain. We're about to go live first week of June. And yeah, just beep it. All right. Thank you, everyone.
Thanks so much, Arpan. So, for those of us that still like to make money manually, and we don't have our own AI agent set up quite yet, we're going to bring on another speaker who's going to share a little bit more about my favorite wallet that's built on Sui, and it's called Slush. How many of you are Slush users? Raise your hand. Great. So about half the room. So for those of you that are not, you're going to learn a lot today, and we're going to bring up Baoer Wan, who is going to teach you how to use Slush Wallet to put your money to work. Let's hear it for Baoer.
All right, cool. Hi, everyone. Thanks, Ranier, for the introduction. So sounds like half of you guys already have a Slush wallet, which means hopefully by the end of this talk, the other half will also download the wallet. All right, so I'm Baoer. I'm the product lead for wallets and payments at Midson Labs. And today I'm going to spend some time talking to you and sharing with you what the Slush team has been building on top of all the really cool financial and payment primitives and tools that everyone has been talking about all morning. And yeah, let's do this. Okay, so first, before we go deeper, kind of want to just talk about why we build the way we do and what we're trying to solve, right? The problem's actually quite simple. Everyone here kind of knows it, which is most people who try crypto actually never end up coming back or they don't stay. And it's very complicated, right? You get a wallet, okay, check. Now you have to actually load the wallet, whether that's through a bridge towards buying on an off-ramp, doing a swap, etc. Every step is very complicated. And then you still have to think about, okay, where do I actually put my money? What type of allocation of asset do I need to actually make this work? It's very complicated. Even for me, it took me a long time to feel comfortable. And in the middle of all that journey, a lot of people just kind of drop off. And that's obviously not what we want, right? As we have seen all morning, and you'll continue here later today, we at Misten and Sui have a strong belief that crypto is going to be a step change improvement for payment and finance. And that's not going to happen if no one knows how to use it. Obviously, agents is one thing, but we also want us, the bio-based humans here, to also profit, right? Okay, so that's why we build Slush the way we do, making it super easy for you to actually access and use Sui. And at the same time, we are the browser to the Sui ecosystem, and we're also a money app, which really boils down to three very simple things: hold, grow, and spend. We want you to be able to acquire, hold your assets easily. We want you to be able to invest and grow them. And ultimately, we want you to be able to spend them and leverage them for your own benefit. Okay, so starting with holding, aka funding your wallet. So honestly, we just created many ways in, super easy for you to get in and get out, right? Earlier, we heard about ZK login, where you can use something like your Gmail, your Facebook to get a self-custody wallet within seconds. And immediately, the way Slush is built, that you can have many ways to fund your wallet, and we make it easy for you to both buy and sell. So there is no concept of money trail, you don't have to worry. And here we have an example of a feature that just went live today, which is now you're able to buy Sui Dollar natively within the wallet. And you can use various instant payment options like Apple Pay, Google Pay, or ACH. Get in, get out, no friction. Awesome. And I just want to take a quick beat here on why we're talking about USD Sui so much. We're all very excited, right? Because USD Sui is really a really good ethos for what we're trying to do here, which is you don't want your money to stay idle. You don't want your money to not work for you, right? And as we have learned earlier today, USD Sui is a perfect example of a stable coin that's not sitting silent. It's not sitting quiet. USD Sui automatically by default actually is earning yield off of their treasury, and that yield is being injected back to the ecosystem, bringing benefits to the builders and also to the users that are transacting with it. Okay. However, if you want more than just a default, this is where Slush strategies come in, right? We want you to put your money to work. So kind of like what I mentioned right now, to actually invest in DeFi. Now, if you're a DGen who knows what you're doing, obviously you can create a lot of opportunities for yourself. But most people are not going to understand that. You have to pick the protocol, pick the right ratio of asset, understanding what's the difference between an LP, a vault, whatever it is, and different chains, etc. So we collapse all of that complexity into a one-click in-app thing we call strategy. So here again, you can see the example using USD Sui, which is also live as of today. You pick the asset you care about, and then you click the strategy, right? If you want something safer, maybe more stable, you can pick a native staking, you can pick a lending pool. Or if you want to have higher yield, you can go for a vault, as an example. And again, we make it super easy. If you don't have the right asset that you want to invest in at the moment, no worries. We will auto zap for you at no cost. And when you withdraw, same thing, you can withdraw in the same type of tokens, or you can withdraw as stablecoins, also no cost. So you can see we basically wrap the entire complexity into an in-app experience, and you never have to leave the app. You invest, you see your portfolio, and then you withdraw. Okay, so I spent a couple minutes talking about funding your wallet, holding, and also growing your asset. However, as a money app, obviously money isn't real unless you can actually spend it and then benefit from it, right? Which is why today I'm very excited to announce for the very first time, Slush Card is coming. Yes, thank you. So for the first time ever, you will now be able to spend your Sui asset, turn that into spending power, and it's going to be accepted anywhere major card networks operate. Okay, so I won't have too much time to go into a lot of details, but just to share a few key points with you. Again, we care a lot about making your money work for you. You should be able to spend without selling your DeFi investments. So here's what happens, right? You can choose how you want to basically pay it off. When you spend, your asset that powers the card is still earning yield for you. Taking a step back, many of you guys know right now when you want to actually, spend the money you have made in crypto. First, you have to convert to a stablecoin. Then you have to send it to maybe something like an exchange to off-ramp it, fund your bank account, and then pay, right? This process is very arduous, and oftentimes you have to generate tons of financial reports. In this case, right, you no longer have to do that. You can actually directly spend, just tap and go anywhere where cards are accepted using your Sui assets. And of course, Just want to call that out because I'm very excited what this means for me personally too. 130 million merchants will be covered across 150 different countries. Okay, so how do we do this, right? So it really comes down to you will be able to repay on your terms. Obviously, when you tap a card, now you have a balance that you have to settle. And you can choose to be simple, just say, okay, yeah, I just pay it off, use my USD Sui, whatever, right? You can also say, actually, I want to pay it off using the invested amount in my DeFi balance. Or you can say, I don't want to pay it off right now. Let me actually borrow against my investments and then pay it off this way, right? So you can see it's going to be super easy. You don't have to do any pre-planning. You don't have to move money around. We basically give you all as an option that you basically configure inside your wallet. And yeah, no transfer, no complexity. Okay, so if any of that stuff resonates with you, this is your time to please take a picture and sign up for the waitlist, which officially opened as of today as well, with our full program coming out later this year. And I wanted to really suggest for you guys to connect your Slush wallet ASAP so you can secure your spot in the priority list. Because once we launch a program, what will happen is we will let you start referring your friends. And when your friends actually activate the card, not only are you going to get a reward from their activation, you will continue to earn a percentage of your spending. All right, so honestly, like my entire talk wraps up into make your money work for you. That's it. That's really what I want you guys to take away. The worst thing we want to do here is to kind of like have our money sit idle and not kind of like get swallowed by inflation, right? And that's why we built Slush the way we have, making it super easy. We wrapped all the complexity. You don't ever have to think about the underlying infrastructure and worry. All you need to do is hold, grow, and then spend. The rail will take care of the rest. And if you've been with us, like half of you, thank you so much. This is a great moment for all of us. And if you're new here, welcome to Slush. This is the easiest way for you to get into Sui. Thank you.
Thank you, Bauer. So, folks, we are almost about ready to break for lunch, but before we do, we have one very important presentation for you. This next gentleman needs no introduction, but I will introduce him anyway. You guys know him as Mr. RV, Raoul Pal, the man, the myth, the legend. He is here in the building, and he's going to talk about the universal code and crypto's next big move. Please put your hands together for Raoul Pal.
So welcome, everybody. Good to be here. Good to see you all. I'm going to do something a little bit different today. It's a whole different framework that none of you have seen before that I've been developing over the last, 35 years of my journey through markets, but also in the last 2 years with my journey through AI. It's a operating system for the universe, bizarrely. It's kind of understandable. It's provable. It's how all systems thrive and survive throughout every observable part of the universe itself. Whether it's biology, whether it's ecology, whether it's cities, whether it's blockchains, it applies to everything. Technology, the human body. It's called the everything code, the universal code. The universal code is a much bigger body of work, but I'm going to show how, for the first time ever, it applies to blockchains. And I think it's going to be very different and hopefully interesting. There's a lot to get through. It's more dense than my usual few slides and a banana, but I think you'll enjoy it. So let's start with the universal code. What we have is this observable phenomena, which is that every network that exists ever maximizes intelligence per unit of energy. It's a fundamental law that I've found to be true everywhere. Whether that's the boss system of the solar system, that top left is actually a picture of the solar system. It's unbelievable. It's a neural network. Next to it is the mycelial network, which is the largest network that we know of on planet Earth, and that's the the fungi that runs under pretty much all land and connects all trees, all life forms. Then we've got a neuron, which forms into neural networks and all of that. And then we've got blockchain, that's Bitcoin. So they're all networks, and they're there specifically to maximize output of intelligence per unit of energy. And it's the same pattern you see at every observable scale. Galaxies, ledgers, that's all the same system optimized throughout all of recorded history. And it's networks at every single level. As I said, whether it's the cosmic networks, the mycelial networks, there's also the same optimization happens at every level. So you can observe it all, mathematically prove it all out. Every network does the same thing. So networks are the way of compressing intelligence in a coherent manner that is effective, and it's what the universe solves for. So things have changed, however. We have been using carbon as the main structure for all of these networks, and now we're running on silicon. And silicon runs 6 times faster than human biology. So not 6 times, yeah, well, 6 times faster, 6 orders of magnitude faster. So it's 1 million times faster. So things have changed dramatically with what's happening with networks. And why networks matter to us in this room today is because what we do in blockchain is all about networks. We're building the substrate for economic coordination in the new internet age. And we'll talk about how it works in the new AI age. But the important thing to know is valuing blockchains is not how people think about valuing blockchains. And I'll come into that in a bit more detail. You see, what people do at the moment, they start saying, how much money does that blockchain earn? How much cash does it earn? Fees. And that's completely the wrong way of understanding how networks are valued. So networks are valued as this substrate of programmable intelligence. It's all of the applications, the value that's built on top of the network that derives the network value, not the fees it generates. So it's built for assets that then throw off cash, but the network itself doesn't need to throw off cash. When you find you use a discounted cash flow analysis, you start solving for the wrong things. Because if output of intelligence per unit of energy is the fundamental law, then it must be the cheapest, fastest, eventually that starts to win the network effects. That is the only way it can work. So therefore, discounted cash flows always make you look the wrong way. So it's the fundamentals of what that chain does, the kind of intelligence density that makes it important. What can you do on that network? You know, what's the programmability? How many unique features? How fast it is? How many applications are built? How many developers there are? This is what really matters in a network. It's this feature, this intelligence density that everything is trying to solve for. And then how do you think about, okay, so what is the value of this thing? I've used Metcalfe's law mainly as the way of valuing this stuff. And Metcalfe's law is basically the network, kind of the square of the number of users of the network, the economic value of the network. But there's an easier way. And Ethereum's the best way of talking through it. Ethereum is the densest intelligence network in blockchain world today. It coordinates more. It has more developers, more activity, more intelligence. It's been around longer, it has Lindy effects. If you took away the layer 1, what happens is all of DeFi goes, all real world assets are on chain goes, all of NFTs goes, all of layer 2s go, all of that economic value and future economic value has gone. That's the value of Ethereum. That's why when people try and discount cash flow Ethereum, they end up with something that doesn't make any sense. Because they say, oh, it looks wildly expensive. It's not expensive at all. The rate at which intelligence density is increasing on blockchains makes them actually very cheap, and particularly where it's going now. So, but what we're getting to is a whole new phase, a state shift in everything that we understand. And I've called this the economic singularity. You guys might have heard me talk about this before. The economic singularity is that moment when we don't understand anymore how things work because things are now working on digital speed and not biological speed. So the infrastructure we've built for the world around us just doesn't stand up. The economics, the politics, the entire system begins not to work anymore because we can't absorb the speed of what's happening. So by 2030, most workers won't be humans. They won't transact most of the volumes. It'll all be agents. Humans will also no longer be the apex intelligence of the planet, which is the most ridiculous change that humanity has ever gone through, and we're about to live through it. Has huge implications. You know, everybody's talking about it, but has huge implications for this industry too. Because this whole change towards intelligence escaping the human substrate and going to the silicon substrate at the speed at which it's happening is unprecedented. Generally, most networks and most observable things will work with, let's say, a log regression. That's the network adoption model, Metcalfe's law. What we're seeing observable for the first time at any scale, the first observable time in history is Reed's law, which is Metcalfe's law squared. So we've got double exponentials going out everywhere. We've seen it with the output of words written by humanity every year since the Gutenberg press has now been overtaken in the last 3 years by AI. AI now produces more words than all of humans added together. By 2028, they'll produce more words than all of humanity has ever written. And that's how fast it's moving. Every chart is vertical. We've never seen anything like it. You can't even put these on log charts anymore because they're moving so fast. And we're not ready for this. So we just have basically broken how the economy is going to work. This move from carbon to silicon, neurons to chips. So we're not the mind that's running this. The whole world is built around our minds running this thing and how fast we work and how we think. But that's not going to be the main thought process. I'm not saying, and I'll come on to later, doesn't mean humans are kind of taken out of the process, but all of the things that we don't need to do, that it can do more efficiently, remember, units of energy, output of intelligence. If the machine can do it more efficiently, they will do it, and we'll find different things to do. And it's that speed, again, 6 orders of magnitude faster, is not something any system is prepared to deal with. Whether it's the banking system, whether it's politics. Politics can't deal with AI. They can't deal with blockchain. They're just not fast enough to deal with how fast this is developing. And it's developing at the fastest rate of any technology we've ever seen. Election cycles are 4 years. How can anybody vote on this stuff? By 4 years, we'll have superintelligence. It's insane. In 4 years' time, the largest workers in the economy are going to be agents, not us. So we're just not set up for this. And it changes kind of how everything around us is. The other amazing thing is people say a simple thing is humans are the most efficient compute ever invented. You know, we use 20 watts of energy to run our brains. Yes and no. Yes, we have this multi-factor model that we run. We've got sense and sight and sound and all of this stuff. But generally at intelligence level, when you actually look at, people say, well, look how expensive AI is. Well, last thing I checked, I'm paying $200 a month for my Claude Pro, or Max, or whatever one it is, and I get PhD level intelligence on every single subject known to humanity. That's cheaper than feeding the human. Yes, they're making a loss. So feed a human, right? Think of those terms. That's the energy input for humans. Energy input for humans, let's say on a globalized average basis, maybe you spend $10,000 on food. So $10,000 to get human level compute. That's the energy output of intelligence. What we're talking about here is we're talking about hundreds of billions of dollars to train these things. But one model gives 900 million unique instances. So it's very, very cheap to produce this intelligence. It's why it's scaling so fast, because it's so much more optimal than any human could ever be. So that's happening. The other thing that's happening that people may have missed is that the meme coin explosion was really us, via speculation, speed testing a very, very big idea, which is for years, the whole financial system has been built around the infrastructure of raising capital and investment of that capital. And what happened with meme coins is we saw instant capital formation. In fact, we saw instant capital formation by anonymous people and reaching into the billions. We saw it, one of the amazing ones, where the nexus of AI comes in, was the token that launched by suggestion by the Terminal of Truths, who was on Real Vision talking about this, Andy Ailey. And the Terminal of Truths wanted to raise money. Mark Andreessen gave him $50,000. And then it suggested on Twitter that it should have a token called Goatsy. and somebody launched it. Nobody knows who launched it. It got to $1.5 billion. It then mentioned another one, Fartcoin, and it went to $3.5 billion. One agent created $5 billion of economic value. Now, when it comes to business models, this is where it's going. Agents can instantly raise capital, take advantage of an opportunity, instantly destroy capital, and the economic system velocity is beyond what we can comprehend. It's not made for us anymore. And this whole economic singularity thing is no longer a prediction. When I started talking about this about 4 years ago, people thought it sounded kind of extreme. And now it's looking like it's the reality we're facing. I don't think 2032 anymore. I think that's too far away. I think by 2030, the entire economic system has changed. And I'll come into why it changed. And it's down to this, the magic formula. The magic formula is how economies work, how GDP works. And it's basically population growth is the main input, plus how productive those people are. That's generally the intelligence output of the units, which are humans, and then debt growth. Debt growth has papered up the cracks when population growth slows down, and I've shown that that's the everything code that I've spent so long talking to everybody about in the past. So that's the system that it's working, but what's happening is if you apply it to GDP now, everything changes. So what happens is suddenly you change humans, well, not change humans, into the human population of 9 billion people, you add in AI and robots. Again, people haven't got the head around robots. People are thinking of C3PO being a nice little robot that makes a cup of coffee for you or whatever, or helps you. We're going to put AGI brains into humanoid robots that are more dexterous, faster, stronger, fitter than us, with smarter brains. That, to me, is a new species. That's where we're going here. And they're going to come into the workforce very soon. We've seen the production lines ramping up already, so it's coming. And we're going to put these super brains into them, and we're going to compete with them in jobs? No, we're going to acquiesce to those jobs because we don't want to do them. We'll find other stuff to do, which I'll come on to the sec. So what happens is you start to get weird outcomes because you're going to suddenly go from a restricted population of 9 billion people to an infinite population of economic actors. So we'll start to see GDP growth doing crazy shit. 1 minute's 10%, next minute's 30%, depending how fast it scales, how far up Reed's law we go. The robots are not Reed's law because they're very difficult to manufacture, but the AI is infinitely fast and getting faster. So we're going to see that. Then also, we're seeing the energy density compute efficiency formula, which is the universal code law number 1, operating at scale, because what we're seeing is the collapse of the cost of creating energy. Now, whether that's solar, which we're seeing at scale, we're now going to space with solar at scale. We're seeing renewables at scale. Most people don't realize China added more solar power last year than the entire world's standing stock of solar, because they realized how efficiently cheap it is to produce. And, we had the breakthroughs in shale, but it's not fossil fuels. Fossil fuels is the backdrop to this, but really the Wright's law efficiencies of cost plummeting are coming from the renewable side, and it will come from nuclear as well. And then we're seeing compute costs collapsing as well. We're seeing the per token cost of energy coming down as well. So we're seeing a double exponential of Wright's law happening both at the same time, both in the output of productivity and the input and energy costs. So what does that do? Drives the firewall even faster, which is scary thinking how fast it is now. We ain't seen nothing yet. It's only going to get faster and faster and faster. And the last part of this equation was debt. This is the world we've been living in. That's the everything code. Debase the currency. Debase the currency by 8% a year so you can manage the debt growth. But over time, debt as a percentage of GDP will go. It'll be close to zero. And the reason being is because GDP is going to go up so fast. And this is what even the US administration has been talking about, is about once you start driving up productivity growth by AI and you start bringing in robots and AI into the workforce, you basically erode the debt away to nothing as a percentage of GDP. And that's the plan, because you can't get rid of the debt any other way. So let's get into Sui and how it fits in and why this all matters for blockchains. This framework, and I've only shown you one of the 4 universal laws, the whole thing applies to almost every system that we can observe, from politics to economics to financial markets to blockchains to technology. Once you see the world through this lens, and I'll do some more presentations on this over time as I start kind of unveiling this huge thing that body of work I've been working on for this. But for blockchains, it's pretty straightforward. So let's look at Sui, which is, I think of as the intelligence applied to the coordination layer. So we talk about speed a lot. Sui's bloody fast. But really, we need a lot more things to compete for the agentic economy. So what Sui has, or what it is the most intelligent substrate ever built for coordination. This is what we're dealing with, and this is what people don't understand, and I didn't understand until recently, because it's not really built for the world that we're in today. It's built for the world we're coming into right now. And we saw Arpan talking about agents. We've heard a lot of talk about agents. This is happening right this very moment. So the same law that you apply the output of intelligence per unit of energy, you can apply to chain architecture too. And it truly matters. What decides what system thrives and survives and which dies. It's this lens makes you understand which blockchains are going to do well and which ones won't. And it makes it observable and understandable. It doesn't become such speculation. So on Sui, there's kind of 3 special features that give it this more intelligence density than any other blockchain. One of it is the object-centric model. So each asset has its own thread of computation. Nothing wastes energy looking things up. So it's not doing the endless loop. The chain knows where intelligence is before it has to find it. So that's efficiency. It's fast. It's quick in doing that. Then parallel execution. Well, that supercharges it all. Most chains process 1 transaction at a time, but Sui does this magical thing of parallel processing a lot of transactions in one go. So it's the same amount of compute, but it's exponentially more efficient and more intelligence comes out of it. And that's very, very important for the world we're coming into. And if the universe selects for this at every observable level, then this is an important metric. The other one is the move language. So it's specific, its programmability, is one of the key features. The density of features without the surface area for failure, just the cleverness of the new language allows a lot more to be done on it. So we've got 3 component parts here that are very important, that creates more intelligence than any other chain. Now, Solana is a chain I love, I use all the time, and this is not a diss on Solana, and none of the comparisons are a diss on people. We're all part of an ecosystem here. But on capital density per user, and this is a really important metric, basically what is each user worth to a chain? If you give a new user to Solana, it's worth $1,600 per year. And if you go to Sui, it's worth 2,000. And that's TVL per active address is how you calculate it. There's a number of different ways of calculating it. But what's interesting here is Sui's a lot younger than Solana, yet it's already accumulating economic density above pretty much every other chain, apart from, obviously, Ethereum. And it's quite remarkable how it's done it in such a short period of time. And it's done it because it solves for output of intelligence per unit of energy. It's faster, cheaper to produce more intelligence. So over the same period when I measured some of these, I looked at a lot of chains using AI, obviously, to help me do this. And what we found was that as these markets had fallen 80% in the newer tokens, what we found is all of them lost coherence, which means that they suddenly didn't hold together in economic density and it fell apart. So economic density changed when the market fell. There are only 3 chains that exist outside of Bitcoin, because it's not a smart contract platform. Only 3 chains held economic density. There's real signal in that, and that was Sui, Solana, and ETH. And it's a structural sign that there is something going beneath the surface with Sui that is not apparently obvious, because it's early stage, it's difficult to see. So each Sui transaction does more than Solana on each transaction itself. And they've got Sui, Solana, and ETH here. So we've got full finality. I shouldn't say less than 300 milliseconds, but it will be over time. We work on it. Solana at 12.8. Obviously, they've got Alpenglow coming out. They will get down to sub-second. ETH is slow, but they're working on changing that. Operations per transaction. This is the killer one, right? People don't really understand that we can do 1,024 in one transaction. Solana, it says one, but it's not really one. You can actually do more, but it's limited by compute. And then you've got ETH at 1. Transaction costs, Sui is obviously extremely cheap, the cheapest. And effective cost per operation, when you take into the account the number of operations per transaction, you get to an absurdly low price, which is why we're able to offer stablecoins for 0. Right, so that's a very efficient way of scaling economic density. So an agent, when we go back to AI world, will do lots of transactions. And on any other chain, those transactions all have to be sequential. On Sui, they can all be 1. So that makes it hyper efficient for AI. So if AI is solving for the universal code, then AI will route over time to the most cost efficient, most effective way where it gets the most output of intelligence. It's not a one winner takes all. There'll be certain things that don't need that. Others need the ultra security of ETH layer 1, of which there is no comparison. It'll do that. And so we'll see different chains developing. But what my working hypothesis is if we look at every observable network platform architecture and look at who wins, how many players win, in almost every scenario, it's 3 to 5. There's only ever 3 to 5, and everything else is a tail. And those tails can be not good projects to specialist, smaller niche. I think there's only room for 3 or 4 layer 1s. We don't need any more. And the race is who's going to be the third with Solana and ETH. That's it. That's the whole game. And from everything that I looked at, and I did a lot of work on this, I don't see any other ecosystem that comes close to what Sui is able to do, and it's provably getting there. So I think it's very, very interesting to use this lens. So when we look at direction speed, this is the acceleration phase that you see over time. What we've got is obviously the more mature chain ETH showing lower rates of growth. Why? Because it's massive. Solana still showing good rates of growth, but Sui's showing extraordinary rates of growth. And that's a good sign. We're early stage, we're doing what we're supposed to be doing, which is as a startup, we're growing faster. We're producing more economic value per user than Solana. So we're doing some good things. We're nowhere near economic value of ETH, but that's okay. But it's not about price targets. It's about how to watch the substrate, how to see the universal code working in reality. And to see it, I found there's 3 metrics that basically signal when you get to the point where you've now become fully coherent as a network and your place is not questioned any longer. And it becomes observable. And I went back tested this over Ethereum, back tested it over Solana. And what you get is 3 main metrics that really matter. And they are, you want to see 2 times stablecoins versus your TVL. It's the dry powder, the potential energy in your network, right? Think of stablecoins as stored energy in your network. You want to see a lot of it. We're not there yet. We're about 1 times. We're about equal to TVL. But what I know and what you guys will have heard, there are enormous amounts of initiatives coming out of Sui on stablecoins, also on TVL. But I think that will be the next one to go. In the middle is active protocols. You guys, builders, everybody building on this, you matter. Now, some of the projects work, some don't work. But to have a number of projects all trying to solve problems, finding product market fit, developing new ideas, that's active intelligence density on the network. You're bringing smart people onto the network to use the technology available. And usually it's about over 300 that starts to matter. We're at over 500. And from what I see, speaking to people over these last few days, there's plenty more activity coming. So that's great. We're seeing more developers coming. and we're seeing people building on the platform. I know that's a big focus for Sui right now. The other is daily active users. Daily active users, I've cleaned the number as far as I can because there's so much crap in all of these numbers. We're about 300,000 a day. We need to be over 500,000. We've been over that in the past. Obviously, the market's subdued. I take a smooth average over time as well to smooth out the volatility. Obviously, all we really need for that is a better market. But also, if the guys in the middle tier, the builders, get more traction, this thing will explode. If the stablecoins get more traction, this will explode. These kind of multiply the value. So we've got 1 green light, 2 orange lights, and I think they're ready to go. These are the things to watch. Just measure these things and you'll know. And we should see acceleration in adoption of Sui, adoption of its price when those things happen. So we talk about price and network value and AI and the agents we're building for agents. It feels a very non-humanistic world. It's not. What this is, and I wrote a piece about this recently, what we're building with these big layer ones is the infrastructure for the coordination layer of the digital world. That's what this is. And unlike the internet, unlike the internet, we actually get to participate in it. Everybody, in every country in the world, anybody with an interconnection can put 10% of their wages into this. So if you think you're going to be replaced by the AI, and the AI is going to do all the economic activity on chain, and it's going to make the chain really valuable, then you want to own a basket of layer ones tokens. And that's basically your pension plan that solves for what is about to come. It's the way of economically participating on an equal footing with the agents. They're not taking your jobs, they're giving you an opportunity. This is humanity's pension plan in the post-AGI world. This is how it's going to work. And so there's no other way of funding it. What are you supposed to do? Tax an invisible economy of agents? Yes, I think they can tax energy use at data center level and hyperscaler level, but it's not easy. But this is the way to do it. This is the way for us to participate, and people have to focus on it. This is why price does matter in this. It's not just about speculation. It's actually about something bigger. If we're building the infrastructure layer for the entire digital world, we need to participate. So the wealth comes from owning the substrate, that fractionalizable, permissionless, incredible thing that we built within blockchain allows us to do that. Anybody with a phone and internet, we can move anything through it. All of the economy routes through it. The financial system's about to route through it. The agents will route through it. The robots will route through it. It's all coming. It's all coming on this coordination layer. And in the end, we get to be humans. And humans drive huge value from each other. This is where we'll get our income from, is by being humans. Getting together is a human experience. I've talked about this with things like chess. Chess is no human has beaten a computer at chess for 35 years. Yet the chess industry is the biggest it's ever been. Why? Because we like watching humans compete with humans. Sports events, sports teams, cost of sports teams, all going to the moon, cost of holidays, the amount of travel, all of these human experiences things. There's plenty of money to be made from human attention and experience, and blockchain will help us do that too. So to sum it all up, the universal code is the law by which everything operates. And I showed you just a part of it, law number 1. Networks are the substrate from which it all happens. It always has been and always will be. It's the most efficient structure the universe has ever developed, and the whole universe is structured around a network itself. The agentic economy is that law going exponential. And again, this will not operate at Metcalfe's law speed. This will be Reed's law speed. You have no understanding of what is about to come because our brains can't even get around exponentials, not double exponentials, but that's where we are. Sui is the intelligence applied to the coordination layer. It is provably the most intelligently dense, efficient architecture of any blockchain that exists today, which is fantastic. There'll be a world of multiple blockchains. There has to be. We will be one of them because of this. And if we focus on that and build accordingly and build great products and great experiences, this is where we win. That dashboard I gave you, the stable coins versus TVL, active addresses, number of protocols being built, that's the dashboard in real time. And the universal basic equity, which is owning the token, this token and others, is the way you don't get left behind. So anyway, that in a nutshell is why it all matters for us.
All right. Thanks, Raoul. Folks, that concludes our morning session. So we're going to take a quick break for lunch. For those of you here in the studio, we're going to pick things up again at 1 p.m. For those of you on the stream, that's going to be at the top of the hour. And you want to make sure you come back and get glued to your screens or put your butts in the seats because we saved some of our best content for this afternoon. Thanks, everyone. See you soon.
Text a message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. Text a message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. Text a message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. Text a message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. Text a message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. Text a message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out Text a message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. Text a message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. Text a message, I don't know the number. Flexing every bone and muscle. Steady Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. Text a message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. Text a message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. Text a message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. Text a message, I don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan. don't know the number. Flexing every bone and muscle. Steady taking shots, never hurting them. Even then, y'all don't worry nothing. And I like to give a shout out to my with the game plan.
And we're back. I love how prompt everyone is. Thank you, folks. Give yourselves a round of applause for eating lunch super fast, scarfing it down, and hustling back over here to get ready for our next presentation. Now, we have three gentlemen who's going to join us up next on the stage for a very important fireside chat. They include Gabor Gurbacs, the CEO of Open Assets, and he's also a senior strategy advisor at Tether. It includes Matthew Horne, who's the head of strategist and product for Fidelity Digital Asset Management, and our very own Mustafa Al-Niama, who I must say is probably the most fantastically posh person at our entire company. He's the head of capital markets at Miston Labs. Please give a warm welcome to all these three gentlemen.
Thank you for this shout out on my outfit, but I don't pay your salary, so flattery won't get you anywhere. Well, thank you, everyone. I hope everyone is energized, still energized at 1 o'clock. We are joined by two great trailblazers in digital assets. We have Gabor Gurbacs, who is the CEO of Open Assets, and who had actually served in multiple other seats prior to that. And we have Matt Horne, who is the head of digital asset strategists at Fidelity Digital Assets Management. Both are trailblazers, but they come from two completely different perspectives and backgrounds. So first of all, maybe we start with Matt to hear from you how you got to becoming so involved in digital assets within Fidelity, and maybe tell us a little bit about your background, and similarly with Gabor. And as you introduce yourself and your background, I think the first question is, out of $100 trillion of RWAs that are going to come on chain in the next 5 years, hopefully, how much of that you think is going to be on public programmable chains versus on private chains in a walled garden? Matt.
Excellent. Well, thank you all for having me. Matt Horne, I run the digital asset strategist team at Fidelity and some of the product function as well. So think of us as really another asset class within the broader asset management organization. So we believe crypto is an emerging asset class that warrants the attention and sophistication that we give all of our other asset classes. So it's a very exciting time to be part of that at Fidelity. I've been here 14 years. My first half of the career was spent in exchange-traded funds, which, for those of you who don't really know, that vehicle really disrupted the mutual fund industry tremendously the last 20 years. So I had a front row seat to kind of that disruption and watching it play out. And at the same time, I got exposed to digital assets, and I had my wow moment that was, this is going to change everything. And that's kind of how I pivoted 7 years ago into this role now. So a lot going on at Fidelity. We spend a lot of time with clients focused on crypto as an asset class, but also crypto as an enabling technology, and really bringing real world assets on chain, tokenization. And it's a massive opportunity for asset managers. Bold predictions, 2030, trillions coming on chain. I think it's going to be split, right? You're going to have use cases for permission chains and in public chains. And just knowing how institutions operate, it's going to be slow and methodical and risk averse. So maybe you see a slight tilt in some use cases toward some permission use cases, right? Other institutions might be more comfortable with this technology. They've been playing with it for a lot longer and using it for different use cases. Maybe they go more aggressively toward a public chain use case. But I think, like most things, over time, it'll be a mix based on the use case. But either way, I think it's an exciting time to be in this industry. So,
thank you, Matt. Gabor, what's your take on this?
Perfect. Hello, everyone. My name is Gabor Gurbacs. I'm the CEO and founder of Open Assets, and also advise Tether. I spent my career building infrastructure for digital assets. I was an engineer in 2012 at Bitstamp. There was not much crypto going on at that time, just Bitcoin. And then I got a real job after that, joined the asset management industry, and built VanEck's crypto division. In that capacity, we're the first asset manager to file for a Bitcoin ETF. And I was the guy that was running around Wall Street and presenting to boards at various companies about, putting crypto assets into, and at that time, again, Bitcoin into ETFs. And then I changed my career from putting crypto into ETFs to putting ETFs on crypto. And it's kind of interesting because what Mustafa mentioned, there's this 100 trillion revolution going on. So it's really difficult. I've built some of the consequential ETFs in the market, especially those with specialty exposure, Bitcoin, semiconductors, esports, emerging market country exposure. And the ETFs are efficient instruments, but the infrastructure that it runs on is extremely inefficient. It's basically 50 to 60-year-old technology and paper pushing back and forth. So that's what we are working on that's what we are fixing with Open Assets. And we power some of the largest category defining leaders with our technology. And again, we work with Sui, of course. This is a performant and reliable chain. And we work with the Intercontinental Exchange. We work with Amazon. We work with Tether, the largest stablecoin in the world, and a bunch of other banks and nation states and around the world, providing this technology in a way that everyone can use.
Thank you very much.
Yeah.
So thinking, Gabor, maybe kind of continuing with you, most tokenized assets today are effectively a line and a ledger in an ERC20 or ERC3643. As you think about, scaling this and kind of thinking about the asset as something that carries its own attestation, compliance, restrictions, all things that are characteristics of that asset, do you think that the kind of account-based ledger is going to continue to be successful, or are we going to need to treat those assets as objects on chain that are treated as a first-class citizen and carry their own metadata and their own compliance rules with them?
So I think it's going to be a mix. It depends on the use case. I'm fundamental in the belief that, maybe I shouldn't say it to this crowd, but like blockchains are dumb infrastructure. They're specifically designed to solve specific problems. You can't do everything on a blockchain. You can't do all of your compliance on a blockchain. You can't do real-time trading. But it's important that certain type of data is embedded natively into the blockchain as an object. And not many blockchains do that effectively. So blockchains do need to get smarter. So I'm on the opinion that blockchains like Sui will win over time because it's important to embed some type of data into blockchains, particularly the origin of transactions and the destination of transactions to comply with things like the travel rule, asset characteristics, and so on. But I don't think that identity specifically should be embedded into blockchains. If you embed, so basically, trusted third parties are security holes, and if you put a lot of data into something, it will eventually get hacked. So my view is that you should put some data, but not much. And so that's a quick summary.
Matt, do you have a take on this, or do you want us to move to the next question?
You can move on.
Okay, perfect.
No views.
So this is a question for both of you, but maybe we start with you, Matt. Delivery versus payment. One of the most painful things, and me coming from traditional finance as well, is the fact that you have fragmented ledgers. It is everything is trapped as capital because you have a T+1, T+2 settlement. And in fact, for those that know, some assets actually settle on T+50. So you literally are sitting on risk for 50 days, and that you have to hedge and that you have to hold capital. Syndicated loans is a perfect example. But when you are trying to compose multiple legs of a transaction for an asset to settle in a DVP, so things like custodian attestation, custodian approval, stablecoin payment movement, the actual asset itself, there are many things, tax withholding, there are many things that you actually have to align to create this type of a DVP transaction. And so the question is, when you think about that, what are the actual limits that we might start hitting when we think about DVP, but at the same time you think of multi-step transaction that would require all of them to either all happen or none of them would happen?
Yeah, it's quite a problem on the TradFi side, and hopefully, with this technology, we can find efficiencies to mitigate some of the complexities here. I think today, basic trades are probably pretty efficient on chain, where you're just doing cash for an asset. But the reality is, I think most institutional trades are complicated. They're multi-leg, 5-6 legs, and you're dealing with multiple assets, multiple custodians, counterparties, maybe tax implications that all have to get kind of considered for and settled atomically, instantly with assurance. And I think it's a complicated problem. And you also have to have the assurance and confidence that it'll be secure, it'll scale, and that if every institution that wants to play on chain can do it with confidence at the same time. So there's a capacity consideration there too. So I'm optimistic. I do think this over time we will get there. I just think today, maybe not today, right? But I do think as more assets come on chain, more institutions get involved in a serious manner with this technology. I do think over time we'll probably get to that panacea state. But I do think over time with DVP, I think you're gonna maybe mitigate some of the frictions right now, but it won't be perfect, I guess. Your time. So.
Gabor, I don't know your take on when you think about things like programmable transaction blocks that Sui, for example, offer that would allow you to do up to over 1,000 transactions within a single block, and it's kind of all or nothing. I don't know if you think that could be a potential solution for a problem like this, where you have multi-steps, but at the same time you want to guarantee that no single-sided transaction and risk associated with that to happen.
Yeah, I mean, Mustafa basically solved the problem already. I think the world is just yet to realize it, and the legal infrastructure has to change behind it. So I think, again, the problem is solved. And if you use something like Sui and use the open asset stack with its matched open agent transfer agency, you can get near real-time transaction and delivery versus payment. It's solved. It's near instantaneous. Now, things get tricky when you have, brokers holding capital and funding times get tricky, but once people realize that the DTCC is largely irrelevant, then DVP will not be a problem. The reason DVP is a problem is because brokers are making too much money, and the DTCC inserts itself to an equation where they are no longer relevant. So again, as of I have two colleagues, Jeff Banman and Surendra Kaladindi here. It was 12 weeks ago, the SEC came up with transfer agency regulations that modernized the rails of how transfer agents can facilitate securities transactions and how to report about it. And so, after that guidance, we came up with the first transfer agent that is basically abides by those rules, and we can do things faster and without the DTCC. So again, you should talk to those two guys, Jeff and Surendra, if you want to learn about it. But I think you'll see basically the rest of the year, very large entities coming up with structures where you don't see central clearing and the DTCC being the main organization. And so again, I think DVP is just one of many issues that you end up fixing if you disintermediate a broken system that's 50 years old, or 60 actually.
Very well said.
You have any thoughts on your background?
I think fundamentally you will need something that can actually combine a complex process that will rely obviously on things like oracles and data sources. So not everything obviously going to be on chain. But I do think something like a programmable transaction block that guarantees you could actually create a very complex process within a single block that either all executes or reverts back is a perfect way of solving for DVP issues across the different types of asset classes. Great. Moving on to the next question. So imagine tokenization work, which we all know will work. And fast forward 2030, we have $100 trillion of assets that are living on chain. They are used as collateral for repo, for derivatives, for private wealth. Now, all of a sudden, you have activity that is at an incredible volume, and especially when you pair that with potential AI and agentic payments and agentic trading. When you start thinking about this and you start thinking about scalability, are there winning chains that are going to be able to handle that type of volume, or are we going to get into the 2021 Ethereum congestion issue? And is there a monolithic kind of model here realistically? Or are we going to be relying on layer 2s that introduce fragmentation? What are your thoughts on that front? Maybe, Gabor, we start with you.
Yeah, I think, first of all, we're not going to go to instantly T+0 settlement, and not all transactions will be on-chain. So that's my first answer. We're going to go to T+6 hour settlements, and then realistically T+3 hours, and we're going to get stuck for years in the T+3 hours world. And then we're going to go to T0 settlement. And because of it, I don't expect blockchains to be needing to perform better than they are today. I think a lot of transactions will still not be on-chain. Realistically, a lot of the transactions will be badged, executed at the end of the day, bundled, lent against. And again, I personally see this as a non-problem because institutions are used to badge transactions, and I don't think that nature of the business will change. Hence, we already covered what we need from a capacity perspective. So that's my simplistic view. If the entire world would just go on chain, sure, then we have somewhat of a problem.
But the solution will not be layer twos. And again, I started with this with a strong statement that blockchains are not great for many things. And so not the whole stack will be on blockchains. I think some of the performance problems will be just solved through superior technology, and blockchains will be matched with superior technology to solve problems.
Yeah, I think that makes sense. Not every asset needs to go on chain, right? I think, again, fundamentally, if an asset is inherently illiquid, a real asset, and it goes on a blockchain, it doesn't make it liquid instantly. And I think we've kind of seen that the last few months in some cases. So it'll be a mix, right? I think, you'll have chains that can handle a lot of this in their natural stack. I think you'll have some layer twos that solve some of these problems too, in some cases too. So I think it'll just be a mix over time.
Yeah, I mean, I have to agree with you, Gabor. There are definitely going to be business practices that will not change just because of the nature of the blockchain and what it's bringing. So if we think about netting, for example, which banks heavily rely on, multi-party netting, that obviously will not go away because it gives an incredible capital efficiency for participating banks. But I do think as we get more and more assets, and hopefully we get to the 100, 200, 300 trillion dollars very soon, I think the amount of activity, especially when it comes to bringing AI and agentics on these chains, will actually explode. So while I agree with you, it might not be a problem in the near term, down the line when you have all of these assets and agents moving them all the time, you're going to start hitting some limitations, and you're going to need to figure out the right model and the right blockchain. So I think we are partially in agreement on that one. When we think about most of compliance capabilities today, they are all kind of bolted on multiple platforms, try to make sure that you are remaining compliant with different types of transactions. But eventually, and I think we've kind of touched on this earlier, do you think like transfer restrictions, jurisdictional whitelist, and attestation requirements need to live on the protocol level or on the asset level? And so, Gabor, maybe if you can share with us how you think about this problem specifically.
Yeah, again, maybe it's not surprising at this point for you guys. I do have a strong view on this. So my strong view is that I believe in freedom, and most things shouldn't live in the token. Some things should, but most shouldn't. So if you end up adding more and more information to protocols, it means that it becomes more and more incompatible with other systems. So the more you embed into the token, the more you restrict your distribution, and that's a problem. So I like to think that some of the functions related to compliance for tokens will remain centralized. And I think 10 years from now, we'll still have, fortunately or unfortunately, compliance officers at banks and financial institutions. And I think they'll just use better technology to pre-screen people to use tokens. For instance, with open assets, we have a full stack, basically a drag and drop system whereby you can collect information from 130 countries and individuals, businesses, and so on. You can custom tailor your distribution in a centralized platform. Then you can deploy a basic Sui-based contractor and other chains too. We're chain agnostic, but Sui is available on the platform, and you can be certain that your compliance requirements are met under your compliance officers programs. But like that piece remains centralized. Because of the explosion in brokerage and crypto exchanges, we got much smarter on how to collect information about people and businesses. And actually, one of the controversial things I like to put out there, and bankers hate it, is that crypto companies now do a better job at AML, KYC, KYB, and KYT than banks. We are 10 years ahead. And the solutions happens to be centralized, and the tokens can be freely distributed, which is, I think it's just kind of cool. Maybe I don't mean to be rude to Fidelity.
No.
He's on the asset management.
Yeah, yeah. Well, I mean, but we're talking hundreds of trillions coming on chain. It's all asset managers bringing products on chain, and these are all securities, and asset managers are beholden to very strict regulations on how we distribute those securities, right? And this is where it all comes together: compliance, KYC, AML. But how do you do it at scale on chain so you can have a better, more crypto native feel to RWA distribution, right? Peer-to-peer, things like that. And Yeah, I think there's a lot of things getting worked on now, but I think that's going to be one of the great unlocks, right? It's sort of like on-chain identity, and how do we, know who's buying these products? Are they doing things in a compliant manner? Are they doing nefarious activities? Whatever it might be. But I think that is a massive sort of unlock for this to go to the size you're talking about here.
Yeah. I have to agree that tokenization and having things on chain improve compliance materially and make it much, much more effective. And part of my work at Goldman, I looked at financial crime compliance uplift for a while. So I got very much involved in understanding the complexities around that ecosystem. And the reality is that something like blockchain, something where you can actually have traceability, auditability, embedding certain rules within the assets themselves, is going to solve a lot of these issues and allow for a much more fluid ecosystem than what exists today.
I mean, absolutely. Even like crypto is global, and that's a massive opportunity for asset managers. You can now, in theory, distribute to a universal client set that maybe you couldn't touch before, given jurisdiction issues. And this is going to be a massive unlock, I think. Things like where are you geographically located to buy a product, that sort of stuff, right?
And by the way, again, just to contextualize why that's important. So 92% of the world does not have a brokerage account. You guys are lucky, and we're lucky to have a brokerage account, but not 92% of the world. 62% of the world still does not have a bank account. And it's because of the jurisdictional issues. It's because you cannot really learn about those people. Tech was not good enough. And I think with blockchains embedding some of the information, you can get a better, faster, and cheaper and more transparent system. So that's sort of from the, Matt mentioned earlier, the ETF world. Like when I joined, Matt is a little bit older than me, although he looks younger. So I joined like ETS around 2013, and 2014 I was talking with the large banks, wirehouses who were buying the ETS that we were creating. And ETFs were roughly about $1 trillion in assets. And I've been talking to this bank and pension fund. They looked at me like I was a drug dealer selling them ETFs. Because you know why? Because there was only $1 trillion in assets in ETFs. They were buying hedge funds and mutual funds, and it was just simply an unusual structure for people to buy. And today, I think, at least like towards the end of the year, we're going to be in a similar situation.
Mm-hmm.
We're rapidly getting to the trillion mark in tokenized assets. We're sitting a little bit north of $400 billion today. And people are just asking the question, should I own a tokenized asset? And, some of these larger institutions are thinking when there's the Strait of Hormuz is closed over the weekend, and I can trade oil 24/7, but, the stock exchange is not open. The brokerage houses are not open. At some point, you have a fiduciary responsibility to provide ability for people to access assets. And I think it's going to be really rapidly suctioning out assets from ETFs, mutual funds, and other places into tokenized structure.
You and I both came from ETFs, right? So I think we like the analogy a lot. And it is a great analogy for what I think tokenization is going to do. The first ETF in the US launched in 1993. And it took literally 20 years to get $1 trillion in that vehicle. And now it is going gangbusters. It's going vertical, I think 11, 12, 13 trillion now.
Just in the US. Globally, it's even 24 or something. Yeah.
And here we are with tokenization, which I truly view as the next vehicle for investment distribution. And it's going to take time, and it's early stages still. But I do think we're going to get to a point here where this is going to hit kind of escape velocity. And it's going to go quick. And I've been in this space for 7 years. I've never been more encouraged because you have the true institutional adults now in the room talking about not so much crypto as an asset class. That was a few years ago. That's kind of here. But now it's about infrastructure, tokenization, the enabling technology of digital assets. So it's a very exciting time for this.
Yeah, I would just add democratization of access is a huge premise here, because not everything when it comes to operational efficiency is all about operational alpha. It's actually about being able to offer the service to a broader set of people without having to incur this massive cost. And that's the reason why we have this disconnect between the wealthy people that have access to brokerage accounts and bank accounts and people that basically cannot afford it because it's too expensive to do it. And I think tokenization, automation of compliance, automation of movement of assets, releasing trapped capital is all going to translate in some way, shape, or form into distribution of these services in a much more democratic way globally. Matt, you deal with pension funds and institutions day in and day out. And when you talk to a pension fund treasurer, they don't particularly want to manage gas fees or gas tokens. They don't want to sign 14 transactions to be able to do one thing. They don't want to worry about MEVs. From your perspective, those are your clients. What is the optimal user experience would be for for traditional institutions that are trying to participate in this ecosystem?
It's a great question because they control a lot of capital, right? So you got to keep them happy.
All the capital. I want that 100 trillion.
I think one answer is just abstraction. Like, how do we abstract the complexities of how we engage on chain and with digital assets for them, right? And I think that's where asset managers like Fidelity and others can really bring their digital asset expertise to bring solutions that abstracts that a bit away. They want certainty, they want finality, they don't want fluctuating fees on something they're invested in, right? So they want a partner like a Fidelity to help them navigate that space. So I think a lot of it is, hey, we'll do it for you now, right? And help you on your journey and just get you into the asset class and the exposure you want. But I do think over time, as platforms abstract the crypto complexities away and it feels less crypto to these kind of non-crypto institutions, I think that's where it really takes off, right? And even on the retail side, I think the same way. The ability to give clients the ability to interact with DeFi is very exciting, for a firm like Fidelity. But if it's complicated and multi-leg for a client to do, you may not have the adoption you want, right? You want to kind of abstract it a bit away. So I just think that's where this goes across all these customer segments, not just institutions.
Yeah, very well said. Do you think there are blockchains that offer the primitives that would allow you to do that abstraction in a much more efficient way? Or do you think all blockchains are created equal and you're going to have to suffer the pain of doing that abstraction yourself?
No, they're not all created equal. I think there'll be winners who do it well over time, right? So
Thank you.
Yeah.
Perfect. Okay.
You want me to respond to Mustafa? Yeah.
We have a million more questions and we can continue going, but I think I'm going to jump to our last question for both of you. And so one bold call from each of you. By 2030, what's the single piece of infrastructure or chain capability we'll look back and say that was the unlock and something we are underestimating today, but we will realize that this was the bottleneck that we needed to deliver so that we can get to the many, many trillions of dollars that we want to see on chain.
Perfect. So what's the solution to $100 trillion problem, right? So again, extremely biased on this, but I think in an odd way, the solution I think is Web 2.5. So how do you merge existing systems with this new technology so that we can transition into better technology? So that's what we're building with open assets. Is if you want to launch an asset on Sui, but you need a transfer agent, you want to settle into a central depository, you want to pay dividends, do all the TradFi stuff, you can do that on a simple platform that is we built for you. So I think that simplicity, simple UX is what we need to unlock this $100 trillion. So that's sort of what we're building. And it's really, really difficult to build simple UX merging all the traditional stuff with blockchains like Sui and other things. So that's my answer.
Short answer with time is on-chain identity scalable solutions there. I think it's huge for asset managers. So that'll be a great unlock looking back 5 years. So,
gentlemen, thank you very much. Thanks, Gabor. Thanks, Matt. Please put your hands together for these wonderful speakers. Thank you.
All right. Thank you, gentlemen. What an enlightening presentation. Next up, we have a special keynote from one of the builders in our ecosystem. But before we jump into that, I want to know who here, raise your hand if you actually went to the Sui Dollar booth in the expo area and on-ramped some money to get some Sui Dollar. Who did it? Raise your hand here. Raise it up high so I could see it. Okay, we see a couple folks. How much did you get? Didn't put the money on. If you did put the money on and you got some Sui dollar, come find me after and I'll give you a very special prize that I do not want to be shown on camera. So I'm not going to give it on stage. All right, we are ready for our next presentation. Without further ado, please welcome to the stage the founder and group CEO of Paga. This gentleman's name is Tayo Oviosu. Let's put our hands together.
It's Sunday night in Lagos, 9 p.m. My friend is driving home when another car runs through a red light and T-bones her at full speed. Glass shatters, airbag explodes. She somehow finds a way to get out of the car and calls me, and we rush to her. She insists that she's fine, but we could see that her left eye was already swelling shut. So we take her to the hospital. When we got to the hospital, within a few minutes, she actually had a seizure. The doctor stabilized her, but then after she was stabilized, they said she had to leave. They don't have a neurosurgeon on call. They refused to give us an ambulance. She's not their patient. So barely conscious, we take her to the next hospital. But before they could admit her, they asked us one question. Can you pay? It was too late to send wire transfers because it can't be confirmed. They wanted cash. Nobody had cash. So 5 of us, 5 grown adults, whose friend is laying there and probably bleeding into her brain, had to go line up at the ATM in the lobby and get the maximum amount of cash we could to pull it together and give it to them before they admitted her. This is not a movie. This happened. I was there. And in that moment, what was between the care my friend needed to save her life was cash. This is life in Nigeria. This is life in most of Africa. The access and use of money is not just a mere convenience. Sometimes it's the difference between life and death. My friend's story is a bit dramatic, but the truth is, across Africa, hundreds of millions of people are going through a quieter version of this same story every single day. Africa has a prolonged financial access problem. If you take my home country, Nigeria, people are still paying for bills the way their parents did, in person and in cash. They go in cash to physically to pay for their electricity, to pay for water, to pay for their school fees. And you add it all up, they're spending an average of 6 weeks a year just paying bills. And it doesn't stop at the border. For the person who is importing goods into Nigeria, or the parent who's trying to send money abroad to pay for school fees for their kid, it takes them 3 to 5 days for money to clear, and they're spending 6.4% in fees. That's about double the global average. So we pay more, it takes longer, and we're cut out of the system of efficiency the rest of the world enjoys. This is a tax on friction, and Africans have been paying this tax for generations. But here is what people miss when they think about Africa. Today, Africa has 1.4 billion people, and we're growing. In 25 years, there'll be 2.5 billion people in Africa. 1 in 4 people on Earth will be African. And while the rest of the world is aging, the African population is young and growing younger. 60% of Africans are under the age of 25. And here's what this generation is about. They're a generation that doesn't remember a time before a smartphone. They're a generation that doesn't have the patience for 6 weeks paying bills in cash every year. And they're already doing quite a lot. 1.5 trillion, almost over $1 trillion every year in mobile money transactions. Africa is already the fastest growing region for crypto adoption in the world. And 12 countries already have crypto-friendly regulations on the books, including Nigeria, including South Africa, Kenya, and Mauritius. However, 57%, and we heard this in the last panel, 57% of African adults don't have a bank account. Now,
When people hear that number, they see problem. I see something different. I see an Africa that is the single largest financial market, greenfield market in the world. And that is the opportunity that we are going after. So what does this generation want? They want something that all of us in this room want, or take for granted, frankly, which is financial freedom. But not just for themselves, but also for their AI agents that they'll increasingly be using to run their lives. Because you know what? For the next billion users, of digital financial services is not just people, but the software that will be running the lives of those people. But financial freedom really comes down to three things. One, the ability to move money quickly and affordably. So no 6 weeks, no 3 to 5 days. Two, the ability to transact globally, regardless of currency, right? Someone in Lagos should be able to transact with someone in Tokyo just as easily as they would someone across the street from them. Three, the ability to save or invest locally or internationally with ease. Your money should work for you and should not be dependent by where you happened to be born. Move, transact, save. That is financial freedom. And this is exactly what we at Paga have spent the last 17 years building towards. At Paga, we have a massive transformative purpose. This is what the company exists to do. This is what gets me out of bed and what keeps us going in the hardest of moments. To make it simple for 1 billion people to access and use money. 1 billion, not 1 million, not 100 million, 1 billion. Because frankly, anything less is not enough. And a goal this big requires a different approach. We did not set out to build an app. We set out to build an infrastructure, the rails that an entire ecosystem could be built on top of. For 17 years, this is what we have been doing, quietly, brick by brick. Today, at the core of Paga is our best-in-class, multi-currency, highly scalable financial services infrastructure. It is what powers our products, and it's what powers thousands of businesses across Africa. And increasingly, it's what's going to power the next wave of innovation on the continent. So how does Paga's financial infrastructure achieve financial freedom? It's the same three things we talked about before, right? So it's move money quickly and affordably. That's our domestic and cross-border rails. It's transact globally and regardless of currency. That's our multi-currency and stablecoin layer. Save and invest locally or internationally with ease. That's real-world assets, bonds, investments coming on-chain, RWAs coming on-chain. Move, transact, save. Built on one infrastructure for Africans by Africans. And it's working. Today, Paga processes $1.5 billion each month. Last year, we processed $11 billion from 169 million transactions. Since inception, we have processed 653 million transactions worth over $42 billion. So let me put that in some human terms. $42 billion are school fees paid, salaries received, grandmother receiving money from her son in the city instantly, safely, and at a fraction of the cost of what it used to cost them. This is what the infrastructure was built for, and we're just getting started. But I'll be lying to you if I said the work is done. Because for all the progress we've made, for all the $42 billion that we've moved, for all the millions of people that we have brought into the financial ecosystem, there are still significant gaps. And these are not small, but they're structural. So let me name them. First, currency instability erodes wealth. When currencies devalue, savings evaporate, buying power goes down. A school teacher in Lagos who has saved all her career watched her earnings and her wealth devalue by 3 times in a year by no fault of hers. This is not a bug in the African system. This is the experience of hundreds of millions of people. 2, Africans are locked out of global commerce, right? A freelancer in Nairobi who has a client in London faces friction at every step of the way. How does she receive the money? How does she spend it? How does she convert it? Each step of the way, there is friction. 3, cross-border payments are broken. We talked about this earlier. 3 to 5 days, 6.4%. This is not an infrastructure for the 21st century, and that is not acceptable. 4, financial access stops at the border. So even for those of us that are fully digital, that are fully on board with digital financial services as Africans, it's still difficult for us, and we don't have it as easy as you would here in the US or in Singapore. These are the 4 walls of the cage. And until we tear them down, financial freedom on this continent is incomplete. But tearing down these walls is not a job that we can do on our own. It requires the right rails, the right partner, the right technology that is fast enough, cheap enough, and global enough to serve 1 billion people. And we found that partner, Paga and Sui. And together, we're building what comes next. So what does Paga and Sui mean for that entrepreneur in Lagos? What does it mean for the freelancer in Nairobi or for the grandmother in the village, right? It means 4 things. And each of those 4 things breaks down one of those walls I talked about earlier. High yield US dollar accounts backed by the Sui stablecoin. This is a wallet that earns yield while money sits there so that your money works for you. Remember that school teacher I talked about who lost 1/3 of her earnings? This is for her. So that wall falls down. On-ramps and off-ramps for crypto, seamless movement for crypto into local currencies with deep liquidity in all the markets we operate. Enabling people to trade easily, receive money, so that freelancer in Nairobi can receive money, keep it in dollars, move it to shillings when she wants, and use it at any time, right? That wall falls down. Tokenized real-world assets on Sui. So bringing real estate, bonds, solar projects from around the world, and enabling Africans so that that African who has $100 can be able to invest in the global economy and grow with the global economy, and where they live and where they were born does not hold them back. That wall falls down. And last but not the least, global financial rails anchored on Sui. This is the foundation, right, of a platform that gives the capability to simplify the movement of money at the speed of email across borders. So 4 products, 4 walls, 1 infrastructure, 1 mission to make it simple for 1 billion people to access and use money. I want to leave you with one last picture. Today, Africa is 1.4 billion people. By 2050, 25 years from now, within the working lifetime of most everyone in this room or watching on the live stream, Africa will be 2.5 billion people. We will have doubled. We will have the youngest, largest middle class in the world, 500 million people with ambition, with disposable income, and the means to participate in the global economy. And here's a number I want you to remember. By 2050, 40% of all young people on Earth will be African. 1 in 4 out of every 10 humans on this planet, the engineers, the scientists, the builders, the artists, will be from this continent. So when we talk about building infrastructure for Africa, I want you to understand what we're saying. We're not talking about building infrastructure for a market. We are talking about building for the future of the world. I started this talk sharing about a friend of mine whose life was dependent on 5 of us getting cash out of an ATM fast enough so that she could get the medical care that she needed. That was 14 years ago. The Africa my friend got injured in is not the Africa we are building. The Africa we are building is one where money moves at the speed of email, where someone can get payment from London in real time, can trade with someone in Tokyo in real time, where a freelancer in Nairobi can leverage the money that she got, and where a young person with $100 can participate in the global economy. That Africa is not a projection. It's not 2050. It's not a fantasy. It's happening now. And right now, it's being built by Paga, by Sui, and by a generation of African builders who refuse to live with the friction that their parents lived with. Africa's future is bright, and we are building it today. Join us on this journey.
Thank you, Tayo. We're going to keep this party rolling, and I'd like to invite our next speaker up onto the stage. This person is going to be talking about the next chapter in Sui's liquidity layer, and that's called Deepbook. Please welcome to the stage the DeFi tech lead at Mistin Labs, Aslan Tashtanov.
Thank you, Ranier. Hi, everybody. Raise your hands. Who here are traders? Okay, great. Who here has gotten liquidated before? All right, I got the right crowd. I got the degens here. All right, you guys are gonna like this one, okay? Today, we're gonna talk about Deepbook and the infrastructure that we're building and all the cool things that are coming out in the next couple of months. Before we dive in, let's talk about what Deepbook is right now. Where are we at? How did we get here?
Deepbook, where sweet finance starts. Spot, margin, predict. 3 primitives, shared liquidity, 1 composable stack. Combine what nobody else can. Build financial products that don't exist yet. Start with the foundation ready. Go from idea to launch, fast. Whether you're building or trading, it starts here.
All right. Deepbook is Sui's native liquidity layer. Originally, we launched with Deepbook Spot, the central limit order book that's fully on-chain, powered by Sui's fast layer 1 blockchain with cheap gas and the parallelism that's needed to really power these high-frequency trading activities on Deepbook. We then launched Margin, a native leverage infrastructure that we added to Spot, allowing users to go 5x long and short on the different liquidity pools that we have on there. And recently, just 2 days ago actually, we launched Predict, the 3rd primitive. It's now on testnet. It's going to be launching on mainnet soon. But this is the 3rd primitive that allows builders to deploy binary markets, the up-down markets that you guys might be familiar with that exist on other venues right now. This means these different components are all natively composable, allowing anyone to use them and build various applications on top, whether it's just pure front ends, allowing users to trade, or using them as structured products where you allow for different risk profiles and unique exposure capabilities for retail users. All of these so far have been built for builders, right? This is just on the infrastructure layer. And what have we been able to achieve so far with that? Deepbook has processed over $19 billion in trading volume, and we have got a flourishing ecosystem of teams that have built on top of it. I'm talking about aggregators, lending markets. We have prop AMMs that are now retail friendly, allowing retail users to participate as prop AMMs. That's Lotus right there. We have Deep Trade and Abyss, the front ends that allow you to interact with Deepbook, trade on it with leverage. So we've proven that we have been able to, build an ecosystem for the builders, right? All of this infrastructure has been for the builders so far. But what can we do more, right? Who should we be thinking about for the next phase for Deepbook? We've done a good job for builders, but now it's time to focus on the traders. Here's what we got coming up next. That was the Deepbook app. It is the first app that we've built that leverages our primitives that we have already deployed. It leverages margin specifically and the latest predict primitive that we've deployed. With this app, you're going to be able to trade prediction markets in a way that you have not been able to do before in any other venue. And why predictions, right? This is, I'm sure everybody's, have heard of many different teams that are talking about predictions. I feel like this is the week for predictions, but this is truly a market that has seen major PMF, right? It is projected to hit $1 trillion in size in just a couple of years. And I mean, the numbers are staggering. And the key note here is predictions, specifically the Bitcoin up-down markets, right? These are all actually options under the hood. So there's actually going to be an evolution of how these predictions turn into options in the long term, and we are here to capture that market. Here are the three unique blockers right now. Here are the three unique problems that we are solving with Predict, and we are the first to market that solves all three of these. Pick any price. I'm talking about the price that you trade against. On other venues, when you go in, you can only trade against markets that are already preset for you. So if you're trying to place a bet whether the price of Bitcoin is going to be above or below some number, you don't get to choose what that number is. On Predict, you're going to have continuous strikes. This means anyone, whether, if you're a DGen that wants a 10x return and you want just those like 10% odd markets, you'll be able to trade those at any time. But if you're a safe trader and you want those, 90% odd markets and you just want that 10% return, you'll have opportunities to trade those as well. All of these markets will be available to you on demand with a singular shared liquidity layer that is going to power every single market. And that's the key difference. On other venues, every single market has separate liquidity, separate independent liquidity. This makes liquidity fragmented across all the different markets. And you can imagine, especially for prediction markets, right? There are thousands of markets that you can deploy. That's why having all that liquidity shared is key to really enabling, high efficiency that we're going to be seeing with Deepbook. We're going to have native range bets, and these are going to be direct contracts that you trade against. On other venues, you would need to purchase two separate legs. Let's say you want to predict that the price of Bitcoin will be between 80 and 85K. You would have to purchase the legs separately and independently. On Bitcoin, that is a native contract that you on Deepbook, that is a native contract that you trade. And lastly, the leverage. We already have margin pools, the pools that already allow us to gain leverage on the spot exchange. We are going to be extending these margin pools to add leverage on top of predictions. I know predictions are already pretty degen, and we're kind of doing a little bit extra with the leverage here, but the capital efficiency is the main thing that we're going for, right? If you are using predictions to hedge your exposure, you want to be able to do it in the most capital efficient way. Now, let's dive into each of these, right? What does it actually mean to have continuous strike, right? Pick any price. What does it actually mean? On other venues, you might go and see that there are specific strikes that you get to trade against. And a lot of times, most of the strikes are already resolved to either 0% or 100%. Really, you only have like 1 or 2 markets that you can trade in. On Predict, on Deepbook app, you're going to be able to select your own strike at any given time. The key here is our shared liquidity pool is able to compute contract prices on demand. That is how we're able to enable these continuous strikes. So users can go in, regardless of market activity, go in and say, hey, I want a contract price for this strike expiring at this time. And the protocol will be able to compute a price for it. Ranges. This is the other key, right? On other venues, you would have to buy 2 separate legs to express a view like Bitcoin is going to be above 80K and below 85K. This means purchasing the Yes token in this example for 62 cents and the No token for 66 cents, paying $1.28. Not only just those prices, but also you pay the slippage and the extra fees on both of these separate trades. On Deepbook, you're going to be able to trade this range as a pure contract independently. This means only paying 28 cents to get the same exact exposure. And on top of that, you only pay 1 fee, 1 slippage. It is just 1 pure market. So there's already a nearly 5x capital efficiency gain in this specific example. You can imagine there are tons of venues that would love to hedge different price levels for Bitcoin. And this is going to be the most capital efficient way to do those things. And lastly, leverage. This is the thing, not only for degens, but also for those capital efficient hedgers, right? On other venues right now, there is no leverage. Leverage doesn't really exist for predictions. And actually, leverage is actually quite difficult to build on predictions. But because of our shared liquidity model and the contracts that automatically compute the price of every contract, the smart contracts themselves can also incorporate the leverage into the contract that you're purchasing. So you're not just purchasing 5 different contracts when you do a 5x leverage. You are purchasing 1 contract that has the leverage within it that defines exactly how the liquidation will be executed, which gives you maximum precision on the liquidations and saves you a ton of money. And here's the most important part here, all right? We're starting with Bitcoin up-down markets. We're starting with what already has PMF. But the key here is all of these markets, they're actually options under the hood. Options is what powers these markets. And this is where we're shooting, what we're shooting for. We're going to use the prediction markets as a Trojan horse to actually solve options on chain. And this means adding more markets, crypto, equities, RWAs, not just Bitcoin, right? Imagine being able to trade the S&P 500 up down 24/7, right? That does not exist. That would be really cool to do. Next, more types of options. Yes, we have the up downs now, but converting that model from just binary options to just, pure vanilla options, calls and puts, bull spreads and bear spreads. All it takes is a conversion of the underlying formula, and the protocol is ready to go to support these new options as well. And we can go even beyond that and get into these exotic options like touch digitals, where all you care about is whether the price is going to touch a certain level before the expiration, and you automatically win. Those will be easy to scale as well. So a lot of unique option primitives that we're going to be building through this protocol. And all of these are going to then serve the, not just the retail traders that want that immediate, leverage and exposure, but also the long-term and institutional traders that want to leverage the protocol for hedging or for getting that extra yield on their underlying assets by doing like writing calls and things like that. And that all ties into the last piece. Structured products, right? One of the main things that we talk about all the time is like, how do we get yield on Bitcoin, for example? Well, this is going to unlock something like that, right? We can have idle Bitcoin, and we can leverage this protocol to then have these lower risk hedging strategies that allow you to get extra yield on your Bitcoin. This is actually what a lot of the Bitcoin treasuries actually do, right? They write calls to get that extra yield. And there's a ton of different things that we can enable once this is all set up. And that is all from me. Join the waitlist, because those that are on the waitlist are going to get priority access to the alpha release that is coming out very soon. And we have a ton of fun stuff that's happening over the next couple of months that you'll get access to as well. And one other note, we also have a booth out there in the expo. So come over, come chat with us. I would love to, dive into the technicals if I need to, or the liquidity profile if I need to. It's a super interesting topic that I would love to talk more about. Thank you.
All right, thank you very much, Aslan. So as you guys heard, the past chapter of Deepbook was built for builders to build on top of Sui's native liquidity layer. The next chapter of Deepbook will unlock great experiences for everyday traders like me and you. So if you didn't scan the QR code, please make sure you see the Deepbook booth in the expo and sign up there to get on the list, because who knows, there might be something special in store for you if you do so. Moving right along, we are going to have a very special panel join us on the stage. And leading this panel is Jerry Morgan, who's the head of DeFi partnerships at Miston Labs. She's going to be joined by Christophe Revaux, who's the CCO of Current, as well as Damien Chen, an OG builder and the co-founder of WaterX. Let's please give a warm welcome to all these folks joining us on stage.
All right, hello everyone. Super excited to be here with you all today. Over the past few years, Sui DeFi has grown quickly, with real users, real liquidity, and core primitives emerging across trading, lending, and stablecoins. And that progress is driven by our builders, teams like Deepbook that you just heard from, also Navi, AlphaFi, a number of others throughout the ecosystem. But as Sui DeFi matures, it's not just about scaling what currently exists. It's about building category-defining protocols. And that's why we created Moonshots. Moonshots is a highly selective initiative backing teams that are building new primitives, new user experiences, and new market structures. And we have two of those teams here today. So without further ado, let's jump into it. Damien, can you give us a quick overview of who you are, what you're building, and why it matters?
Hey everyone, it's Damien, and we are building WaterX on Sui. What we're building is an agentic intent trading engine. Our goal is to bring private bankers to everyone, like every users. Right now, professional finance is like a full-time job. It's complex and time-consuming. So, but we also don't see many wealthy people look at the charts or looking for investment opportunity themselves. They have private bankers or financial advisors. Our goal is to democratize that kind of elite experience.
Great. And Chris, can you give us a quick overview?
Yes. First, a pleasure to be with you here in the room, also online. I'm Chris from Current. We are a new leverage yield protocol on Sui. We launched 5 weeks ago, and we already have 27 million of deposits and 1,000 users, professionals, retails that are using Current and our product Multiply in order to loop the assets and achieve more significant returns. And how this is important within Sui DeFi, users can deposit, users can hold the token, but I think there is one more step that could be achieved using leverage. And this is important because this is also what institutions, professionals, and even retailers are expecting. If they want traditional standard returns, they can go to traditional finance. But if they are in DeFi, this is also for achieving more significant yield.
Great, thank you both. Okay, let's dive a little deeper into both of your guys' approaches. So Chris, Current has been live for 5 weeks. What's one signal that really resonates with users?
Okay, we have been tracking users to understand them better. The one signal is the utilization rate. We have seen that there is a sweet spot, at least for Sui, that is 91%. Below that, immediately users are depositing capital. Above that, people are removing their funds. So we have observed that users really track this metric in order to take decisions. And yeah, I think this is very important. They understand how the protocol is working.
Great. And Damien, WaterX is prepping to launch. How would you describe WaterX in a way that genuinely captures what differentiates it?
What's generally new is we are trying to reshape what a modern financial platform should look like or product should look like. If you take a look at most of the financial product or trading platform on the market, they are like vending machine. They show you their features and like category buttons and want you to learn that yourself. On our platform, especially on the mobile app that we are going to launch in 2 months, the user experience would be like chatting with AI agents. And we have a recommendation system behind that, giving you what you might want to invest or what you might want to bet on. After a user like approve the transaction or they want to do the trade, we also have, in the backend, we also have an agent perform as a orchestration layer, which integrates with our core features like prediction market, perp, lending, spot. So basically, the platform handles all the execution and analyzing, while users just have to provide their intents.
Great. So both of you guys are taking very different approaches to how users are interacting with your protocol and interacting with liquidity. Chris, what's a design decision in Current that you think really matters but might not be obvious at first?
Okay. I think about one, which is the leverage carry engine that Current is currently playing, in a way that using leverage, a user is impacting and modifying what is the supply rate and borrow rate of the different assets. And this can create an opportunity for another user to borrow USD Sui, hold and supply USDC. And what I mean here is like this is a self-correction that is happening by the user within our platform, and that Current is not actively managing interest rate.
And Damien, you've talked about AI, and your focus is obviously very different. There's a lot of conversations generally going on around AI and trading. So how are you guys thinking about it at WaterX, and what does it unlock for your users?
There are many ways to look at how AI bring benefits to user. And on our platform, what we unlock for user is their freedom. So as I mentioned earlier, like finance, professional finance is very time consuming, and it's kind of a privilege for the top like several % user, while the other are told to learn rest of the stuff themselves. So if we can provide an AI agent that do analytics and execution for users, that means they can focus on their passions and their careers. We bring freedom to them.
Great. All right, let's switch gears a little bit and talk about Sui. So, Chris, what excites you most about where the Sui ecosystem is heading?
Okay, I need to pick one topic, otherwise we're going to take the food hours. Sui dollar is something important for me, and because I think Current is already playing a huge role in this adoption. We have about 30% of the deposit already in USD Sui, and we're going to add much more multiply strategy using and that people could borrow USD3 and hold another asset. So I really see USD3 becoming a borrowing reference point in the industry.
And Damien, to you, as you prepare to launch, what aspects of Sui are most important for what you're building?
So before we dive into why Sui, I would like to share why blockchain first, instead of having Web2, like existing Web2 services. If we want agent to work for our money 24/7, we need a financial system that's working even after the bank is closed, and that's blockchain. Crypto and a native asset on blockchain is programmable asset, which speaks native language to agents. So agents are able to manage those assets. And also on blockchain, it gives you natural interoperability that you can access to different chains and protocols. That means wider liquidity and investment opportunity. And if we want to discuss about why Sui, the first reason is that we all love Adeniyi. And like the more professional reason is that the sub-zero speed that Mr. SETI consensus provides. And also there's a ZK login allowing user to log in with Google Auth. And there's also sponsored transaction to abstract the user experience in Web3 into Web2. So building on blockchain and on Sui empowers us to build products that has Web2 user experience and also Web3 sovereignty to users. And in my opinion, that's how a modern financial product should look like.
Great, both fantastic answers, and I think themes and topics that we've been hearing throughout the day. Okay, talking a little bit about Moonshots. So Moonshots is about backing teams that are really pushing boundaries. What's one bet each of you guys are taking that you're especially excited about? Damien, let's start with you this time.
I believe most of the people earn money and like working because they want to get money, they want to say no to things that they dislike and spend more time like staying with people they love, right? So most of the people, they might not want to be a daily trader themselves, but they also want the outcome from professional like management on based on their risk appetite. So I'm betting everything on agentic intent model, where we can continuously learn users' behavior and recommend them the like financial instrument that they prefer. I believe the future belongs to people who stop educating users and start to learn from their users.
And Chris, what about you? What bet are you excited about?
Okay, I'm excited about RWAs. And I mean, my day-to-day is like trying to get net new assets within the Sui DeFi. I think there is no limit. And basically with the tokenization, we're gonna have much more high quality assets as a collateral and also much more yield-bearing assets. And those ones deserve to be on Sui and would be just excellent for the Sui ecosystem in general. So yeah, I'm looking forward for the coming months or years on Sui.
And both of you guys are builders on Sui. Damien, you've been around for a long time. Chris, you're newer to the ecosystem. But what else do you want to see built on Sui? There's a lot of builders here today, some tuning in. But what do you think needs to be built on Sui? What are you excited about? You want to go first?
Yeah, sure. So as I'm targeting more users, it's not just Sui, not just a blockchain. I want to target Web2 user. I want to see the bridge between Web2 and Sui. So that means if user can onboard their assets using Apple Pay, like it's more like agent intent centric stuff that I'm willing to see on Sui.
100% agree with you, Damien. It's like build something meaningful, but also get a very strong distribution. And this is obviously the responsibility of every project. And I think if we work all together, we make it easier. The one project I would like to see is a Pendle-like.
Mhm.
Would be very, beneficial for Current to have a YT that we can potentially loop. So looking forward, I heard some project I might work on, but looking forward to see that live.
All right, we have just about a minute left. What do you want to share about WaterX and about Currents that you haven't shared yet? How could folks learn more about your guys' projects? Damien, you want to go first?
So for us, we want to build like private bankers for everyone. We need to get enough user behaviors data to train our algorithms. So the first step is not like is building the product itself, but now we are focusing on distribution. We have an app launching, like mobile app launching in 2 months. There will be like not just agent, but some like core user experience. For example, if you think Bitcoin is going up in the next 15 minutes, you just swipe right. If you think it's going down, you swipe left. It's like a Tinder-like user experience. We gamify everything, and also we upsell you something that you might want to invest.
And when is that expected to launch?
I'm expecting in a month or 2.
Pressure. Okay. And Chris, how about you?
One thing we realized the last 5 weeks, we are tracking wallets interacting with our protocol, and we're super happily surprised to see funds that are moved from central exchanges directly into Current. So that's a very strong signal for us that if you are providing a good product and high returns, you are capable of attracting new capital within the ecosystem.
Great. All right. Thank you both. This was great, very insightful. That's it.
Okay.
All right.
Thank you.
All right. Thank you, Jerry, Christoph, and Damien. This next presentation is going to be for all you builders out there, whether you're a builder here in the studio or on the live stream. We have a very special guest. His name is Carter Morgan, and he's on the DevRel team at Miston Labs, and he's going to step on stage to tell us all about this year's hackathon called Overflow. Please welcome him to the stage. What's up? What's up? Hey, good. Some of you guys have more energy than others, but we'll be fine. Hi, I'm Carter. I'm part of Miston Labs' DevRel team, and I'm super excited right now to announce the Sui Overflow Hackathon 2026. Who here knows what that is? I need more enthusiasm. Yes, sir. Thank you. I'm super excited about this. Basically, what I'm going to do is I'm going to talk to you about what is Sui, just in case you're not 100% familiar. We'll talk about what is Overflow, some past stats from last year's. We'll talk about the prizes, the tracks, how you win. And then you don't have to wait till the end, but if you want to register for this to sign up, maybe get some of those prizes, you can do that at overflow.sui.io. Sound good? Getting better. I like this. There we go. So first, what is Sui? Sui is a stack that's a complete system of composable parts, decentralized coordination, and composability. So if you think about like a Google Cloud or an AWS, it has storage, it has compute, it has all these components that developers can piece together to build real world applications. Sui is very similar. It's the only platform where assets are owned. Permissions can be owned, they can be programmed, they can be verified. So this gives you a lot of power. And I want to talk about a little bit just about like the different pieces and components that you can use during this hackathon to build your app. So the first one is the Sui, the coordination layer itself. It's like your operating system almost. That's going to be what makes sure that like your transactions are verified, everything works well. And then you start building other pieces on top of that. So that's where Walrus comes in, and they're one of the sponsors for this hackathon. But that's a trusted data layer. So decentralization, you put your data there, it's always going to be available. But then if your data is there, it goes up public by default. So that's where you need something like Seal, which is a decentralized key store. So you can make sure that your data is only accessible by people that you want to access it based on how you programmed it. Maybe they own a token, maybe there's an access list.
Now, sometimes when you're doing calculations or doing computations on chain, you want to be able to work off chain because there's things that are expensive and you want to make sure that they're verified and can be trusted back on chain. And that's what Nautilus is for. It's a trusted execution environment for off chain stuff like AI and whatnot. Then there's Deepbook, which is our liquidity management, right? So that's where like a lot of the money stuff you can build on top of that, the money apps. And Deepbook is another sponsor, and they have a booth as well upstairs, so you can go and talk with them. And another part is SuiNS, which is like identity management. So instead of going to say like a website that's just a 32-character address, you can give it a name like carterstechtalk.suiNS, and people could go to that website. It'll be way better. So that's a quick overview of Sui and what that allows you to do. These different components, they allow you to build real-world apps like the Slush native finance app. So you can do things like make payments, buy tokens, stake tokens, all of that, all through this app. There's also a booth for Slush upstairs too. And then you get other applications like eFrontier was something where players in the world are able to go and modify, using smart contracts, modify different components in the world to change what's happening. That's super cool. I don't know if that registered, but that is like a really cool thing that you can do. And the Sui stack is what makes that possible. So the infrastructure is ready. Like you can build real world production ready apps on Sui. And so that's what this hackathon is for. Now it is your turn. So if you're a builder, if you want to do something with autonomous agents, you can do that. So let's talk about Overflow. It's our flagship global hackathon. We're focused on real world production ready builds. So like an application that you can use in the wild. So not a demo, not a toy, something that's going to be up on mainnet is the goal. He's nodding like, yeah, I'm ready. Okay. And then there's also 500,000, $500,000 in prizes across the different tracks. I thought he was going to nod for that. He didn't. It's fine. So what you're going to get through this hackathon is you're going to get access to Sui's engineering and ecosystem experts. There'll be some workshops and webinars, so things where you can educate yourself on different pieces and different components of the Sui stack. Obviously, there's your chance to win some of the prize pool. And then you're going to be building along some of the teams in our ecosystem, which are really good, really exciting. So really quick, we've been running Overflow for a few years. Last year, there was almost 3,000 signups. That was a 50% increase about from the previous year. And if you think about all the projects that were submitted, there was close to 600 projects submitted. And that was a 70% increase. But something that's really important in the age of AI is like how many of those projects were spam. So 500 of those projects, 450 were legit. Cool. This year, we're trying to do it even bigger, always bigger. So here's the timeline. You have time to do this. We're announcing this right now today. In 2 days, there's going to be an orientation call where you can talk to people from Miston, from Sui, get on the same page and on board for what's happening. And then from now until June 21st is the building period. So go and make this production ready app. June 21st is the submission deadline. And what's going to happen is on July 8th, shortlisted teams are going to be announced. They're going to be able to present their demo July 19th to 20th. And then on August 27th, the winners are going to be announced. I'm sure you guys care about the prizes and stuff. What's going to happen is when the winners are announced, half of the prize for their track is going to be given to them right away. And the other half is going to be given to them when they put their project on mainnet. And if their project is already on mainnet, he gets all the money. You are so excited, sir. Straight to mainnet. All right, so let's talk about some of the tracks. There's the Agentic web track, which is building autonomous agents that can act, transact, and coordinate on-chain. All this is powered by Sui's speed and composability. And then there's the DeFi payments track, which is creating the next generation of financial primitives. So maybe lending protocols or seamless payment rails, all of that. These tracks for the prizes, it's $30,000 for first place, $15,000 for second place, $7,500 for third place, $5,000 for fourth place. And then we also have a few sponsored tracks. And as I said, both of these have booths upstairs, and Slush has a booth upstairs as well. Walrus, the goal for this track is to leverage Walrus to build applications that handle large off-chain or verifiable data. So you think like data for your AI models or something like that. That would be a good option for this. And then Deepbook, the track for that is building or trading liquidity applications powered by Deepbook's on-chain order book. So building the next generation of DeFi applications. And the prizes for this track are a little bit different. It's $35,000 for first place, $15,000 for second place, $7,500 for third place, and $5,000 for fourth place. And then Walrus and Deepbook are obviously sponsors, but also Open Zeppelin as well. Make some noise for them. Oh, there we go. That's great. OtterSec and Scallop as well. Let's make some noise for them. Thanks to all the sponsors. And like I said, that's $500,000 plus in total prizes and rewards across the core and sponsored tracks and some university awards. Again, that money is going to be distributed on the day they choose the winners for half of it, and then the other half once the project is on mainnet. So some really quick questions is who can participate in Sui Overflow? Anyone. So if you don't have to be the most technically savvy person, or you can be. If you have an idea for a project that you think can change the world or can make people's lives a little bit easier, this is for you. A question I get asked a lot is, can people submit to more than one track? No, Greedy, calm down. And then, are there track-specific resources or mentors? And the answer is yes. So once you sign up, there will be a participant handbook, and then over the course of the next couple of weeks, we'll give out information about how to meet with some of these mentors and how to get some of this training if you need or want it. So that is pretty much the end of this. And the goal here is to start building production-ready apps on Sui. So register now at overflow.sui.io. Thank you.
All right, folks, we made it. We have made it to the very end of today's program, and we have two very special people closing out today's session. The first is none other than the president of Miston Labs. His name is Kevin Boone. And if you guys don't know Kevin, this dude just oozes charisma, which you'll see when he steps on stage. The next person, I'm sure, is also a very cool guy, even though I don't know him that well. His name is Guy Wlette, and he is a general partner at A16Z Crypto. Let's give them a warm round of applause.
All right. Hi, everybody. Ranier, thank you. I love how much you exaggerate, but I'll take it anytime. We're almost at the end of all of this. Very, very excited to spend a few minutes with you here, Guy, in wonderful Miami. Because we don't have that much time, we're going to jump right in. So you've mentioned from time to time, especially recently, about a transition of crypto moving from hoodies to collared shirts. And I'd love to dive a little deeper to really understand exactly what you mean and what you're referring to. Is this a reference to institutional adoption, or are you talking about the maturation of technology? You know, what's the reference there?
Yes, it's absolutely that institutions are moving on chain and clearly beginning to adopt blockchains for finance. And I think Sui is an excellent example of that. The kind of quip or analogy is inspired by the social network. The comment of Zuckerberg and his hoodie and his "fuck you" flip flops. We are yes. Retiring those, and maybe starting to put on a collared shirt. If you walk around the conference today, I think you see a lot more people in suits here than you did a few years ago. Yes. I treat that as a very positive sign. I think this is kind of the industry maturing. I think in hindsight, we'll probably look back on October, November last year. Maybe 10.10 is one catalyzing event. And then some of the model releases with Open 4.5 and 4.6 is kind of an inflection point where one, AI agents need a financial ecosystem, and that I think is best fit and suited with blockchains. And then two, kind of a shift in the market structure where you had a lot of speculative energy for a long time, and now I think a lot of the focus is on using blockchains to upgrade existing core ledgers in finance, which I think is. Certainly the speculative energy is still wonderful, but it tends to come in cycles. And I think the product cycle and the financial cycle are sometimes, separate from each other and disjoint. I think that's kind of the period in which the product cycle really seemed to take off. And I think in the fullness of time, usually the product and financial cycle kind of come back into unison.
That's a really insightful comment. Do you have any love lost for the speculation, or are you appreciating this newfound focus on button downs and college?
Yes. Well, I certainly don't think the speculation is gone. You know, if you look at Wall Street,
yes,
that they've been able to get themselves into a pickle or two before as well. I think a lot of it is a transition for the industry as a whole. You know, I got interested in crypto very much from a cypherpunk attitude and perspective, and I think that ethos still permeates the space and inspires a lot of what we do. I think blockchain is both a technological and a social revolution, and I would compare it, kind of to prior literal revolutions. I think you could look at kind of something like the French Revolution, where you had a drastic shift, and at some point, Robespierre gets executed, and the revolutionaries have to start to govern.
Yes.
And it feels like we're at that point in time where maybe the initial inciting energy of crypto has pushed us far enough and kind of created the activation energy for traditional finance to come towards us and begin to reshape and kind of anneal, so to speak. That's something we talk a lot about, the idea of market annealing.
Yes.
That startups make themselves malleable and willing to change. The same way kind of industry incumbents make themselves malleable and willing to change. These two metals are fusing. And I think that's currently happening. Obviously that means we can't all keep our hoodie, but I'm more than happy to trade our hoodie for kind of FIDI moving north into Soho and moving on chain.
Absolutely. On traditional finance and institutions, the world is abuzz about stablecoins, tokenized assets, DeFi rails, but adoption and real world usage are very, very different things. Where are you actually seeing traction? Where are you seeing pull from the institutions?
Yeah, well, I think the first would be stablecoins.
Okay.
I think we see stablecoins in the developing world as a dollar-denominated neobanking account for everyone on Earth. Dollars are a fantastic product, and I think we see adoption from, let's call them asset managers and fintech companies, to not just distribute dollars through stablecoins, but also begin to offer other products that often monetize better, things like investing and wealth management products, things like credit products. And that's why I think you see a lot of energy around capital markets on chain, around exchanges, around lending protocols. Then similarly for stablecoins, I think you start to see larger enterprises, especially in the developing world, beginning to use them for efficiency. And I think a lot of that is very focused on payments today. I would say the regulatory shifts, notably the passage of Genius last year, very positive treatment from the U.S. government, really unlocked a lot of stablecoin and payment-specific use cases. We're very hopeful that some of the recent guidance from the SEC and the CFTC will unlock capital markets and kind of unlock the rest of what finance could be on chain. And obviously, we have clarity going through the legislative process in Washington. We're pretty optimistic about the potential there to also not just literally enshrine in law that a lot of what we want to do on blockchain is the future, but to kind of unshackle the compliance department to say yes to some of the obviously useful business cases that have been in a bit of a gray area because of some of the, let's call it lawfare in the last administration.
Yes, absolutely. Very, very well known and well understood at this point. Shifting gears a little bit to AI, since we are talking about this intersection. I think one of the things that has been we're seeing tremendous growth in stablecoins and payments. We're also seeing a rise in security incidents. I think across the broader industry, in April alone, we've seen over 20 plus. If you're at a DeFi protocol and you are building, as many of the people in the audience here are today, what do you think the industry needs to be thinking about in terms of security in the age of AI advancement?
Yeah, I think, I guess my first point would be almost all of the hacks are not theoretical security hacks. It's not like we need to invent new security models. Almost all of the hacks end up being a misconfiguration or a human error. And I think really what needs to happen is the entire industry needs to take security more seriously. I think the fact that we're kind of asking the question is an important part. I would also say that I think this is not a crypto-specific problem.
Mm-hmm.
I think this is just kind of how software is going to work for the next couple of years. I think we're back maybe in an early 2000s environment where the asymmetry, where a scripts kiddie by kind of the early 2000 lingo, or someone today with access to one of the cutting edge models, they're excellent at penetration testing. Yep. And so I think kind of software as a whole is going to be more vulnerable at this point in time. And so especially in a crypto context where there's a lot of money at stake, you have to think about defense in depth. You have to think about, real maturity in terms of how you run and operate a security team.
That's such a wonderful point, because if you use history as an example and you look at script kiddies and the way this has evolved outside of the crypto space, naturally what should happen is a hardening. As tools advance, we will catch up in that hardening, and then it'll just be this continuous up leveling as it is even outside of crypto and in the rest of the software industry.
Yeah, I think the positive framing of this, you could say AI is making things less secure. You could also say the AI models are so good
Absolutely.
that they are actually perhaps in many cases better at pen testing than existing human pen testers. And I think we have a lot of software that's been written over the last many decades that has not kind of been probably bulletproof to the extent it should be. I think a lot of the code written moving forward will be more secure as a result of being able to reference against the latest models to ensure your initial deployment is good instead of having to remediate in the future.
Absolutely. Absolutely. So a lot of folks today have been talking about agentic commerce and the various flavors, agentic payments, agentic commerce, agents basically acting on behalf of us humans. What do you see, of course, from your perspective, what is real versus hype?
Yeah, I think the important question in what is real versus what is hype is usually like, what is the actual use case? Agentic commerce is a very broad term, and I think what is real today for agents would be coding. Agents are incredible at writing new software, and where do you need payments in the coding process or kind of the software development process? I think my simple answer would be it will be much easier to give your agent access to as many and hopefully every single API through the context of stablecoin payments and things like X402 or MPP than it will be to have to manage all of those API keys manually. I don't know if you've spun up OpenClaw and tried to give it access to iMessage, to Twitter, give it an email account. I think a lot of the challenges there are very simply, I want to give it access to as many services as humanly possible. And the API key management is actually really a pain.
Yeah, absolutely.
And so there are a couple of projects now focused on kind of doing discovery around those payment surfaces. And then obviously, I think the underlying blockchains themselves have gotten so fast. A lot of the work, you and the Sui team have done to make stablecoin payments essentially free and settle essentially instantly, make that a much better fit for kind of micropayments and the kind of per token request style that APIs seem to be moving towards.
So many of us on the Sui team have been monkeying around with OpenClaw and the like, and I still self-identify as a lawyer. I was a lawyer for many, many years, and so I generally think of myself attuned to risk, but just having to manage and resist the urge to just give root access to my whole life is very challenging. So, when we look at the Rails and the agentic Rails, X402, the things that we just talked about, of course, when we look at how banks and financial institutions will interface with those Rails, there has to be the question of why can't they just use traditional finance Rails, them being agents, that is. Do you see a state where it is just purely stablecoin programmable money Rails displacing only traditional Rails, or is it a hybrid? Is it I'm going to use whatever is best for my use case at the time?
Yeah, I think it will be a hybrid, but the closest substitute for a stablecoin payment today would be a virtual card. And I don't know how many of you have tried to, for example, pay for things on chain through a PSP with a virtual card or with a credit card, but very often those payments get declined. Like I'm still consistently shocked when I try to Apple Pay on a crypto app that obviously depends on the app, but I was talking to a founder last week who was saying they were having something like 80% of the transactions declined by the PSP, which is just entirely unacceptable. And so I think there are hybrid solutions you could kind of cobble together an approach with existing cards. You'd obviously have to change all of the economics. Credit card fees usually charge a fixed 30-cent fee, and then there's very high interchange, which doesn't make any sense for micropayments. So you'd have to see a lot of how kind of existing payments work change very, very quickly, which I'm somewhat skeptical of. I think for things like consumer payments, the stablecoin backed card makes a lot more sense and is a wonderful hybrid solution. But I think for agents making very small value payments at very high volume on chain today, almost certainly stablecoins are the best technological fit for that. And it's really more of kind of a go-to-market question to ensure that the products and services that kind of we have, as an industry have built get to market faster than the incumbents can upgrade their tech.
You just mentioned cards. We've also talked about X402. When you look at agentic commerce, there's, I think, a surfacing number of themes, either in the orchestration level, like stablecoin orchestration, also cross-border payments. Do you feel there's any underrepresented parts of agentic commerce that you would like to see more of?
It's a good question. I mean, I think the question with all of these things is what is the killer use case, right? Like on chain today, the two things that seem to really work are stablecoins and perps, and I think most successful crypto businesses are some second order effect of those killer apps. So when we're thinking about agentic commerce, my question would be, what is the agent doing? And I think the initial killer app there is payments for APIs and kind of API fractionalization, API key management. I think almost certainly there will be other examples here that this is more the domain of our AI team, but there are a lot of companies now trying to move from kind of API consumption on a per token basis to offering seat and services models. And I think, specifically what the agent is doing will make a lot of difference in kind of how agentic commerce flows out of that. What I do have pretty strong confidence in is that DeFi is essentially a financial system that I think really by accident fits perfectly with kind of the hallucinations that you maybe get from an agent, and with the ability for those agents to participate permissionlessly without going through some registration process. And so I think the high level details make a lot of sense today, but I would pay very close attention to what agents are actually doing very, very well, and then almost certainly there's some economic workflow there that becomes a really good fit for blockchains.
Thank you. That's food for thought, folks in the audience that are builders.
And if you're building a company,
we love this. Yes.
We just raised a big fund.
Yes, congratulations
I'm
on
very
Fund
interested
5.
in investing in
Yes,
agentic commerce.
Yes, that's great. You heard it here. So we're almost out of time, but I want to ask a little bit of an offbeat question. Knowing that the audience is who the folks are, is there any one strong belief or strong conviction that you actually think most people here would disagree with?
That most people disagree with? That's a good question. Oh, we should have talked about this beforehand. Yeah, I mean, I think one that is particularly interesting to me, I think we have a chance to build a whole new kind of credit ecosystem. So that would be one. Then I think, the second would be compute and energy, which I can talk about in a second. I think the massive number of dollars of outstanding stablecoins today, though, they will absolutely look for higher yield opportunities. And if you think of what a stablecoin is, at least Genius compliant stablecoins under American law look very similar to narrow banks. And I think a narrow bank is an interesting product, but if we move all dollars to stablecoins, we'll have much worse capital formation if we replace existing banks with narrow banks. And so I think there's a real place for vaults and lending infrastructure to build a new kind of credit market or new forms of capital formation on chain. This also kind of rhymes with how lending has worked outside of a crypto context.
Yeah.
Before the great financial crisis, you had a lot of direct bank lending that shifted, both in part because borrowers wanted to have a direct relationship with their lender, and because of regulation like Basel III, which changed kind of the capital requirements and return on equity capital for a bank. So banks started to lend much more towards private credit funds.
Yes.
The private credit, equity buffer would be the first loss as opposed to the bank, which a number of regulators were very positive about and was kind of the shift they wanted to see. And so who do private credit funds actually really lend to? Well, usually that ends up being a private equity sponsor that is, taking a loan from a private credit fund and buying a business in order to transform it. And, I think private credit is in an interesting place today. With some of the redemptions that maybe you've seen in the news. And I think there's an opportunity with kind of how credit works in the traditional world changing, and the real demand on chain for vaults as a result of stablecoins to kind of see these two trends come together. And I think we're in an interesting moment for that. So we've worked with a number of companies there, and I spend a lot of time with Morpho, which is top of mind on this.
Yes.
Then I think kind of the other things. I think we have AGI. Maybe that's my hot take that people would disagree with. I think the important component to scaling it is access to compute and access to energy. So both physically can we make the chips, but in many cases, data centers are sold out of capacity through 2028 or 2029, depending on who you talk to. And it's actually very hard to get powered land. And so I think, this is not just a technology problem, but this is kind of a coordination problem or a capital markets problem. I think blockchains will be very good for that. I think when we see kind of new asset classes emerge or professionalize, perhaps in the same way that payments in the developing world leapfrogged from cash to touchless on your phone. We never really had physical credit cards in large parts of the world. I think sort of new capital markets for especially compute and energy might move from being largely traded OTC to being traded on a blockchain directly through a decentralized exchange. And so I think that's kind of one of the most important questions. And if we believe in agents and agentic commerce working really well, I think you obviously need to be able to literally serve the tokens that power those agents. And probably the most important part of that today is being able to produce more energy and being able to produce more chips.
Marketplaces for compute, the world's most important resource.
There we go.
Absolutely. Absolutely. Very quickly on the lending and loan portion that you had, do you see any particular opportunity when you're comparing even traditional loans in like student loans, auto loans, or is this really more limited to the private credit piece and solving actually the private credit dilemma?
Yeah, I think it will come in all forms. I don't think it's specifically related to private credit, although I think we've seen a lot of energy from some private credit asset managers who want to move on chain today. I think the other version of this would be what Figure has done with HELOCs.
Yes.
I think that they have a really interesting playbook there. And if they've done one thing really well, I think it's understand the customer and kind of meet the customer where they are today. And so I think that's again this process that crypto is going through, where we've built fantastic technology, and I really don't think we have kind of a technical bottleneck to adoption anymore. I think it's much more about understanding what the existing customer needs and kind of being willing to meet them where they are and sell a product that they can use from day one.
Amazing. Guy, thank you again for joining us on this very
Kevin.
dense day.
That's fun. Yes.
And thank all of you in the audience as well for
Thank
being
you all
with
for coming.
us. Great. Take care.
All right, ladies and gentlemen, that concludes our program for today. Thank you guys so much for spending your time with us. To the hundreds here in the studio or the over 100,000 that joined us online, thanks again for spending your day with us, and we hope you enjoy the rest of it. Cheers.